Here in New York City, I'm Shauna Smith along.
Stock futures right now edging higher this morning for the Dow, the S&P 500, and the Nasdaq, continuing last week's positive tone as the S&P 500 posts its best week in months. Plus, a fresh batch of corporate earnings, including Apple and Amazon. They're going to test the recent optimism in the markets.
In the market, looking ahead to the Fed's upcoming decision on Wednesday, policymakers are expected to keep rates unchanged, but investors are going to be parsing through that statement that we're hearing from Fed Chair Jay Powell, listening for any hints of rate cuts later this year. So let's get right to it. The three things that you need to know at your roadmap for today's trading day. Yahoo Finance's Jared Blickery, Akiko Fujita, and Alexandra Canal have more.
Futures are edging higher this morning ahead of another busy week on Wall Street. Earnings momentum pushing S&P 500 futures higher as the benchmark index comes off its best week since November, also snapping its 3-week losing streak. Now, investors are awaiting a Fed meeting, earnings from Apple and Amazon, and April's job report.
Plus, Tesla CEO Elon Musk wraps up his surprise visit to China. Musk making his second trip to China in less than a year to expedite Tesla's full self-driving tech rollout. Chinese officials reportedly telling Tesla that Beijing has tentatively approved the company's plans to launch its full self-driving software feature in the country, according to Bloomberg. This win comes at a pivotal time for the company that's looking to strengthen revenue growth and EV footprint.
And a C-suite shakeup for Paramount. Shares are jumping today on a Wall Street Journal report that says Paramount's board will replace CEO Bob Bakish over ongoing discussions around a potential sale. Bakish is expected to be absent from this quarter's earnings call and potentially ousted from his role sometime this week, according to the Journal. The company does report first quarter earnings results after the bell today.
Well, stock futures are climbing to start the week after the S&P 500 came off of its best week in months. A Fed meeting, the April jobs report, and earnings will test the recent optimism in the markets here.
The latest decision on interest rate policy is happening Wednesday. Investors will be listening to how the Fed is interpreting recent higher than expected inflation data. That announcement coming ahead of April's jobs report, which is going to be out before the bell on Friday.
And it's another big week of earnings. We're going to get results from Amazon and Apple. Outside of the tech giants, we've got plenty of other companies reporting. As you can see behind us and on your screen right now, McDonald's, Mickey D's, the Golden Arches, Coca-Cola, and Starbucks, the brand of the green siren, just to name a few. So let's get you set up with the market action so far on this Monday morning. And most notably here, as we talked about and perhaps daisy chaining on what we were saying on earnings that are expected over the course of this week. Interesting here, the communication services sector, according to some FactSet data, is reporting the highest year-over-year earnings growth rate of all 11 sectors right now this earnings season. And particularly if you look back to two big tech companies of the Magnificent Seven that reported last week, Microsoft and Alphabet. We're looking at you. If these two companies were excluded, the blended year-over-year earnings growth rate for the communication services sector would fall from 22.4% down to 2.3%.
Yeah, and that exactly points to what we have been discussing over the last several weeks, the importance of the Mag 7, especially this earnings season, given that growth that is expected. And not only that, but also the guidance. You mentioned the rates, the beat rates that we have been seeing up until now during this earnings season. And we can see just in the reaction over the last week or so that if you meet expectations, even if you beat expectations but don't raise your guidance, that doesn't seem to be enough here for the street. And then the flip side, if you do report a miss, we've been seeing many of those stocks really punished pretty heavily here over the last several trading days. So let's take a look at where things stand here this morning as we kick off a new trading week. You got the Dow futures pointing to gains at the open. That is the same with the S&P 500 as well as the Nasdaq 100. So continuing that momentum that we ended the week, a lot of that driven by the optimism or excitement that I should say surrounding the earnings results that we got from Alphabet and from Microsoft after the bell on Thursday. And taking a look at the 5-day moves that we have seen in the S&P, you're looking at a gain of nearly 3%, 2.7%, the best week that we have seen for the S&P since November, I believe. And the same for the Nasdaq. You saw a gain of just about 4%. So the huge move to the upside, and that Nasdaq chart really illustrating the importance of tech and the reliance of tech when we talk about the market's recent momentum.
Absolutely. Huge setup for this week. Another big company we're going to be tracking, as always, Tesla. Shares are jumping this morning after Elon Musk wrapped up a surprise trip to China and came away with a big victory. Chinese officials reportedly telling Tesla that Beijing has tentatively approved the company's plan to launch its full self-driving software feature in the country, according to Bloomberg. Yahoo Finance's Akiko Fujita is here in studio with us and has more on this. Great to see you, Akiko. What do we know?
Yeah, good to see you guys too. This was a whirlwind 24-hour visit for Elon Musk going into China. He had a slew of meetings with top officials over the weekend, including Chinese Premier Li Cheng. Now, that paved the way for the news that came out today. Bloomberg reporting that Tesla has gotten approval for its driver assistance system, full self-driving software in China. That comes through a partnership with tech giant Baidu. Tesla reportedly tapping into the company's lane navigation and mapping services. Now, working with a Chinese company is certainly critical for Tesla. It's a big way to get over some of the regulatory hurdles within the market because of concerns around data security. Bloomberg reports there are conditions attached to this, though. That has not necessarily been reported out in terms of the specifics of the deal, so something to be looking for. Now, the good news for the company, and the reason why we're seeing shares pop, is because what this means for the company's revenue. Remember, we were talking about Tesla last week, saw its first decline in the quarter since 2020. This is a new source of revenue if they're able to tap into the world's largest EV market. Specifically, the company charges $8,000 for their suite of features here in the US. It's $99 for a subscription. And of course, we're talking about not just the slowdown that we've seen for Tesla. We have seen them really been engaged in a price cut war, which doesn't seem like it's going to stop, and they just had 10% cut. So this is good news, at least from an investor standpoint, if they can really tap into this.
Yeah, exactly. And I think that's the question, right? What you just ended with there, just exactly if they are able to tap into it and what demand is ultimately going to look like. Because we've seen the problems, obviously, that Tesla is facing in China. You talk about the rise here of domestic competition, and they're also the ability to compete on price, which I think is huge, especially when you're talking about that region of the world.
Yeah, in many ways, the market necessitated this. You could argue if you think about other Chinese EV makers, XPeng, Xiaomi, there's a slew of those names. I mean, they are all going in on self-driving as well. Now, something to consider, it's not a China story, a US story, but this specific, self-driving or autopilot, we should say, in the US, has been under investigation from NHTSA. So it hasn't been a smooth ride per se, but at least the fact that they were able to meet with officials, get some of these regulatory approvals, at least according to Bloomberg, is certainly good news.
It certainly is. You can see that in the stock reaction here at This Morning, right? Akiko, thanks. Well, interest rates in focus this week as the Fed meeting kicks off tomorrow. The central bank is widely expected to leave rates unchanged, but traders are going to be watching closely for any signs of rate cuts later this year. The S&P 500 coming off the best week that we have seen since November. For more on this, let's bring in Scott Wren, Wells Fargo Senior Global Market Strategist, is here. Scott, it's great to talk to you. So we're certainly going to be a busy week here for Wall Street. You've got a slew of important earnings results. You don't have to look any further than the results that we're getting from Apple and Amazon to highlight the importance of this week. When it comes to quarterly results, we've got the Fed meeting. We've also got the jobs print on Wednesday. How does this set up, do you think, the equity action that we're likely to see in the coming days?
Well, I think it sets up where you've got the things that have tested the market, Mag 7 earnings, what the Fed's going to do, inflation, employment. You have all these things that are going to come at traders and investors this week. So, clearly the unemployment report is very important on Friday. And then the FOMC, we're not going to see any surprises there. They're not going to do anything. And, I think they've made it pretty clear the higher for longer narrative. So we'll just see how Chair Powell hammers that home on Wednesday at the press conference.
If that is hammered home and the reality that investors have to really grapple with for the near term, perhaps even through December, is higher for longer, can the market still see all-time highs even amidst that?
I have to admit, I was a little surprised when, you're coming into the year, the market's expecting 6 or 7 cuts. It drops to 3 or a touch below, and all the market did was set new record highs. So, I don't think that's really going to be the case from here on. And, we've got 2 cuts penciled in this year. If I had to guess on the timing, and it's a pure guess, it would be September, so it's far enough ahead of the election, and then December after the election. But certainly, if we're wrong, it's going to be fewer cuts, not more. So I think that, Chair Powell talked tough at the summit he spoke at a week or two ago, and I suspect that's likely to be the case because let's face it, whether you're looking at, if you're looking at core CPI, which is a percent above core PCE, or just CPI in general, it's way too high for the Fed.
Scott, when you take a look at some of the recent action that we've seen in the equity markets, you don't have to look any further than last week. You've got the S&P and the Nasdaq both coming off the best weeks that we've seen since November. I want to focus, though, on some of the movement that we've seen in tech, especially on the back of the results that we got from Microsoft and Alphabet after the bell on Thursday. How does that set up this week, just in terms of how much is relying on the Amazon and Apple prints and exactly what that's going to tell us about markets momentum here to the upside?
Well, these big growth names, they've been, for the most part, knocking the cover off the ball. But I think, from our perspective, as the market, when it was making record highs, when it was running up, you both mentioned tech and communication services. I mean, those two sectors look overvalued to us, and we've been trimming money from both of those sectors. But clearly, the market is going to hang at least for a few days on results from these Mag 7 companies. So we know what's been driving the market. It's largely these big names. Usually that's what carries the market into some sort of a top. But those results are going to have meaningful influence on what happens, at least in the short term.
And it sounds like from what's really propelled the Mag 7 that there's going to be more spending in the near term for those companies. So CapEx is going to rise, but for other companies that are really not going to be beneficiaries of generative AI hopium, what are they going to need to see within the consumer demand environment to prop their earnings?
Well, that's right. On generative AI, that's one of the reasons why we like industrials materials, because clearly to build data centers and a lot of other things, improve the electrical grid, industrial companies are going to do the building, and materials are going to be used to do all of that. Things like copper, we're seeing copper up a lot. But overall, I still think that these other companies, the spending we're going to see, we're going to be still doing a lot of deficit spending. Consumers who, in our opinion, they're nearly tapped out. They've gone to 401ks. They've tapped home equity lines. They've done all sorts of things, run up credit card balances. So consumer spending, we're expecting it to slow. It's clearly been strong, and certainly the GDP number had some strong spending in that. But we're looking for that to fade. It wouldn't surprise us if we had a couple of other, high 1 point something readings in GDP as we move through the next couple of quarters. So we think that infrastructure spending is going to be good, but consumer spending is likely to weaken a bit.
Scott, let's talk about some of the other moves that we've seen, specifically what's going on in the currency markets, because you've got the yen here, dramatic moves that we've seen to start the morning. A lot of that driven by some expectations, suspected intervention. When you see a dramatic move like we did this morning here in the yen, what kind of risk factor is this a risk factor here for the broader markets?
Well, I don't know if it's really that much of a risk factor for the broader market. When I look back, I was a market maker in dollar yen, and I quoted the Fed on intervention in 1990 to 1995, kind of the golden age of currency intervention. And I think that, these days when somebody like the Bank of Japan intervenes, they're more quiet about it. They don't announce it. But, they obviously have to intervene with traders. And so that's why you're seeing some news wires out that, the Bank of Japan did indeed intervene. They try to do it when the market's a little thin and everybody's leaning the same way, which in this case is long dollars and short yen. And so I think, as far as the currency moves here, the Bank of Japan, the fundamentals have to change. And given where their economy is, which is really not in a good place, you can't expect, rates to go up much there. So we would expect the dollar to remain strong. You don't get this kind of a move, a 4-yen move, probably without intervention. But I think probably, at least on a short-term basis, if the Bank of Japan did hike rates, that would have a negative effect probably on the overall market. But once again, the underlying Japanese fundamentals don't look great. And so, we're expecting the dollar to remain strong against the yen this year, and strong against the euro for that matter.
Scott Wren, Wells Fargo Senior Global Market Strategist. Thanks so much for taking the time here with us this morning, Scott. Good to see you.
Have a great day, guys. Thank you.
You too. Well, our stock to watch this morning, Paramount. We're looking at a possible C-suite shakeup. Shares rising on a Wall Street Journal report that Paramount's board is considering replacing CEO Bob Bakish as discussions around a sale of the business heat up. Here with more, we've got Yahoo Finance's Alexandra Canal. Hey, Allie, what do we know?
Hi, Brad. Good morning. Well, according to the Wall Street Journal, Bob Bakish could be out from his position as soon as today. Now, in his place would be a consortium of division heads, at least for now. The announcement could come just before the company reports earnings after the bell today. So something to certainly watch as we near closer to those earnings results and the call. Now, Paramount has long been rumored as a potential acquisition target. The company is currently in exclusive negotiation talks with Skydance Media. Those talks are set to expire on Friday, and a deal is unlikely to get done since some of Paramount's largest shareholders have expressed concerns over this deal, saying that it unfairly benefits Shari Redstone and her holding company, National Amusements, which is the controlling shareholder at Paramount Global. They would much prefer a deal with Apollo Global, who is the parent company of Yahoo Finance. Apollo Global did offer a $26 billion all-cash deal to take Paramount private. Now, this would provide a cash payout to some of those biggest shareholders, but it would lack the premium that Shari Redstone would receive with that Skydance deal. So there's been a lot of back and forth talks, a lot of question marks, especially heading into this earnings report about what Paramount is ultimately going to do. They are certainly in a very tough spot with cord cutting is accelerating. We've seen streaming losses really escalate at the company as well. So we're all watching this very closely heading into earnings, but this potential CEO shakeup could have very serious implications on the company moving forward. So all something we're going to be keeping an eye on throughout the course of the day.
You certainly will. All right, Allie, thanks so much for breaking that down for us. Well, we are just getting started here on the Morning Brief. Coming up, Apple getting some love on Wall Street. Bernstein saying it is time to be like Buffett and buy the stock. We'll explain why after the break. Plus, don't miss our brand new show, Catalyst, debuting today at 10 a.m. Eastern Time. We will dive deeper into the biggest stories moving the market today. We are putting tech's massive spending in the spotlight. Just how much can these tech giants spend on AI before worrying Wall Street? We'll break that down for you. And later, SoFi reporting another profitable quarter. The company is seeing a huge jump in personal loans. CEO Anthony Noto is set to join Brad during Wealth in that 11 a.m. Eastern Time hour to break down that report. That's an interview you certainly do not want to miss. We'll be right back. Time for some trending tickers here at Yahoo Finance this morning. First up, Apple. Shares are getting a boost, up just over 2.5% in pre-market trading. Bernstein upgrading the stock from market perform to outperform, keeping their price target at $195 a share. Now the analyst behind that call encouraging investors to be like Buffett and buy shares while the stock is, quote, relatively cheap. So we have Bernstein coming off the sidelines on Apple after 2 years. And the real reason for this, they're saying be like Buffett. A lot of this is based on valuation, where exactly Apple is trading. Positions on Apple when the multiple is 25 times earnings or below, trimming it at 30 times earnings. So they're making the argument that it's more attractively priced at these values. And they also think some of these fears that we've been talking about so many times at Yahoo Finance about the slowdown in iPhone demand, especially what's going on over in China, that some of those fears maybe are a bit overblown at this point.
Right. Simple message with this note. Buy the fears, what they're saying. And they're saying going into this May 2nd earnings report as well, expectations are low entering into those Q2 results, fiscal year Q2, with about $80 billion in revenue guidance for fiscal year third quarter. So all of this considered, they believe that the guidance can serve as this clearing event for the stock, basically. They're kind of drawing back to 2013 and 2019, even going back for those who want to think about Apple pre-pandemic. So ultimately going forward here, you mentioned some of the risks that the company has been facing, that investors have been trying to get ahead of in the waning iPhone market share, right, or the waning smartphone market share right now, especially coming after a year where they had gotten up to that 19.9% level, which was essentially the high that they've been able to see on the global side. But you've got some international competition that's certainly taking the cake as part of the story early in the year right now.
Yeah, and it's also, I love how he drew the comparisons with Buffett, obviously, ahead of this meeting, ahead of Berkshire's annual shareholder meeting, which I'm going to be out in Omaha for this weekend. But I think this is really the focus here, and I'm sure Buffett is going to get some questions just about how he views Apple at this point. There has been so much emphasis placed on struggling demand, exactly what that's going to look like. Maybe this next iPhone isn't going to be the catalyst that it has been in prior years for the company, and ultimately what that means. Also where AI stands in the AI race, where Apple stands in the AI race, because they have long been criticized as lagging some of their other tech giants and some of the rivals out there in terms of some of the advancements that they've made. So it will be interesting to hear how Buffett is viewing all of this as well this weekend. I'm
just smiling because this is what we hear from more of the telecom CEOs about. We're waiting for the next big iPhone. We're waiting for the next big Samsung or Pixel that's really going to
hoping it's great for their businesses.
People breaking down, just door-busting type of technology innovation.
Yeah,
it's not there yet right now. All right, well, we'll see. We're going to be waiting for it. Also, let's talk a little Phillips here on the morning. Phillips shares skyrocketing this morning after reaching a $1.1 billion settlement over its recalled ventilating devices in the U.S., a payment that was much smaller than anticipated. Phillips has not dealt with the fallout from the recall for over 3 years and saw its market value slashed by about 2/3. So a little bit of relief, at least, that it's not as high of a settlement as it perhaps could or should have been, but shares in relief rallying right now by about 33% this morning.
Yeah, and I think you can tell by the share reaction here this morning ahead of the market open, but also the tremendous amount of pressure that the stock has been under in recent months, given this uncertainty and exactly what this settlement would potentially look like. And I think judging by this morning's reaction, a jump of more than 30%, Jeffrey summed it up in just one sentence here, saying that it's much milder than feared and also marks the end of that litigation uncertainty, that cloud that has been hanging over Phillips stock here in recent months. Now, remember that this also prompted a change in the executive ranks, the new CEO coming in. Also, the company had to make a lot of tough decisions, including some cost-cutting efforts, cutting 10,000 positions in order to save costs. So now that they have reached a settlement and it's not as bad as feared, we certainly are seeing some of that relief rally taking place here this morning.
Yeah, company also reported results for the first quarter of 2024, and they said that they delivered first quarter results that were in line with their 2024 performance improvement plan.
All right, switching gears to some more earnings that were out this morning. We also want to take a look at Domino's. Shares climbing higher after reporting same-store sales in the U.S. rose 5.6% from a year ago. A lot of that was driven by stronger delivery demand. You're looking at gains of just about 5%. Yahoo Finance's Brooke DePalma is all over this for us, joining us at the desk with the details. Brooke.
Yeah, good morning, Shauna. Good morning, Brad. Certainly a strong start to the year for Domino's Pizza here. Revenue and adjusted earnings per share beating expectations set by the street. Revenue coming in at $1.09 billion, higher than Wall Street estimates. Adjusted earnings per share also coming in higher at $3.58. Now, let's break down three three key drivers from this quarter. The first one is that third-party food delivery services. We saw Uber Eats be a key incremental sales driver this past quarter, bringing in roughly 1.4% of a sales mix for the quarter. Now, they do expect to increase marketing and awareness throughout this year. They also noted that, believe it or not, single-serve customers are being gained on the Uber Eats platform, and they expect to exit the year with an overall sales mix from Uber Eats of roughly 3% or more. Now, the second key driver here was value and promotional activity. Domino's Pizza execs saying on the call that they saw gains across all income cohorts, in particular low income benefiting from value. They also had that emergency pizza promotion, and they expect Domino's Rewards to be a meaningful sales driver in 2024. And lastly, we continue to watch lower ingredient costs benefit fast food chains across the board. They do expect their food basket to be in the range of 1 to 3% higher this year, but they said that if it does come on the lower end of expectations, they could see a lift in operating and supply chain margins, and this could be a key indicator for the rest of what this week could look like. We also have McDonald's, we have Starbucks, we have Restaurant Brands International, Wendy's, and Wingstop all on the board this week.
Busy week
and so
for you.
this could be a key indicator of what we could see: value, low income, continuing to flock to fast food.
Domino's shares up like 5% here pre-market. Domino's saying, what Ozempic?
right.
People are still ordering small
People
serve.
still want a cheap, good meal on the go.
There you go. Brooke, thanks so much for talking all things pizza with us at 9:26 a.m. Really hungry now. All right, from food to student loans, SoFi shares are down after profit came in above expectations in the first quarter. The company seeing a big boost in personal loan and student loan originations, climbing 11% and 43% respectively from a year ago. But the biggest jump came from home loans, which were up 274% from the first quarter last year. Stay tuned. We're going to have much more speaking with the CEO, Anthony Noto, on the back of these results. That is coming up at 11:40 a.m. Eastern Time during Wealth on Yahoo Finance. Well, we're also just minutes away from the opening bell on Wall Street. Yes, bing bong. Ahead of the big week with economic data and reports on tap from a bunch of companies. How are the markets reacting? We've got that for you right after the break. Stick around. All right, we almost have the opening bell on Wall Street. Let's do a quick check of the markets, sponsored by Tasty Trade. The Dow futures right now pointing higher, as are the S&P 500 and the Nasdaq futures. We've got that opening bell happening for you right now. At the NYSE, you've got the great folks from over on, well, I saw the company a moment ago, but hey, let's get to the fancy hats over at Churchill Downs ringing the opening bell at the Nasdaq. A little bit of festive funfetti, the hat wear. Peak hat wear, all-time highs over there. All right, we're taking a look at, and of course, just as I was about to look at the company that's ringing the NYSE, they're gone.
Yeah, Brad, it's going to be real interesting. I love that. It's a reminder. We got to get our outfits squared away before the big race.
You want to do a big outfit day for the Triple Crown?
Maybe that's going to be Friday. Okay. Get everyone a little bit hyped up for this first
Not
race here. But let's talk about some of the action that we're seeing here, because it is going to be a huge week for the markets. A lot of earnings on tap. And then you've also got some key economic data out later this week and a Fed decision. So we've got the Dow trading to the upside. You've also got the S&P moving to the upside here, pushing further above 5,100, and also the Nasdaq. So much emphasis, so much focus here on some of those tech giants and that momentum to the upside that we're seeing. That's also playing through here at the open with a gain of just about 0.4%. And real quick, let's take a look at the sector action and some of the gains that we are seeing there. Consumer discretionary real estate there leading the way. Communication services actually lagging. So let's get for more of the movement that we are seeing at the opening bell. Jared Blicker is staying by at the big board with a closer look. Jared.
Well, thank you, Shana. We are seeing the S&P 500 come off the best week since I think last November. I want to stick with the sector action because we had some really big developments last week. A lot of volatility in communication services with Meta, and then we also had Alphabet earnings. Now, let me just show you a 5-year chart with some candlesticks to show you what happened. We had, actually, let me show you the 2-month first. We had dipped below critical support here, and you can see this line, trying to draw in. There we go. And then we just gapped right back above it. And that was on the Meta loss and then on the Alphabet gain. So we don't see that too often, but big reversal there. Faked out a lot of traders, blew out a lot of stops. Bottom line, communication services is rocking here. Let me show you the 5-year chart right up against its prior high here. So maybe pause a little bit before advancing beyond. Maybe put in a cup formation, we'll have to see. Also want to talk about the Nasdaq 100 here. I was just talking about Alphabet. You can see it's down about 1.5% today. In fact, mega cap's looking a little bit red here, but here's Apple. Apple up 2.6%, looking forward to those earnings. And we also have Amazon in the green, getting earnings from Amazon later this week. Had a huge day Friday, I believe. Tesla also up 10%. Just want to close here by showing copper. Copper is now advanced. This is a 5-year chart to the highest levels since basically 2022, and we're right up against these highs. Lots of implications for the manufacturing sector, the industrial sector. So this is something we'll pay attention to, but right now, no cause for concern, guys.
All right, Jared, thanks so much for breaking that down for us. Well, Treasury yields climbing to start the year, and really this movement higher that we have seen, a tremendous movement higher that we have seen in recent weeks. This after fresh inflation data, making investors a bit nervous about the outlook here for rate cuts and what exactly that timing is going to look like for the Fed. To break it all down and how to best position your portfolio, we want to bring in Gregory Peters, Co-Chief Investment Officer for PGIM Fixed Income. Greg, it's great to see you. So first, just taking a step back here, because it's going to be a very busy week here for the market. So much is riding on these earnings results, exactly what that is going to tell us here about maybe that momentum to the upside for equities. But what about the bond market, some of the trends that you're noticing here with when you have the 2-year just shy of that 5% level?
Yeah, no, this is an incredibly important week. We have the micro earning reports coming in and lots of macro factors. So, I mean, what we're focused on is really what the Fed is going to say on Wednesday, which I think is not going to be all that interesting, other than the fact that Powell has to walk back being more dovish. And so the data has kind of worked against their earlier narrative. And so what I think you'll see coming from Powell and the Fed this week is, you know, some more time, some more patience, and the prospect potentially for a rate hike, not a cut. And I think that is something that the market is incredibly focused on.
Greg, for a market that's been propelled by really 7 names that has now shrunk down to just a handful at this juncture, Alphabet and Meta really putting the team on their back for this earnings period here right now and accounting for much of the contribution to the earnings growth for its sector and information technology specifically. How going forward here can tech outpace or offset or even supersede where this higher for longer from the Fed is going to continue to be the talking point?
Yeah, so I think if you zoom out and look at the root cause why the Fed isn't cutting rates, it's actually a positive story, right? So the U.S. economy is much stronger than anticipated. Inflation, yes, above trend, a little higher, but that type of backdrop is pretty favorable for broad earnings. So I would be less focused from an investment standpoint on what the Fed is going to do and why they're doing or not doing such a thing. And if you look at it in that manner, it's a pretty positive backdrop for risk assets.
Greg, you just mentioned there a moment ago that the street is becoming a bit more focused on a potential rate hike. How likely is that from your standpoint at this point?
Well, I don't think it's the base case by any stretch, but if you kind of suss out what the market's telling you, it's about a 30% probability at this point. But it's the change from the start of this year, right? If you rewind the clock back to January, it was a fait accompli that the Fed was going to cut, pretty substantially this year. There was a narrative in the marketplace back in January that you would see 50 basis points in March, and clearly that hasn't happened. So it's the change, I think, that has taken the market by surprise. So, I do think it's a remote chance, but it's not a zero chance. And I think the market is getting its hands around that.
Where are there hidden opportunities right now that some investors would be apt to pay closest attention to, even outside of where the overcrowded areas of the markets are right now, from your perspective?
Yeah, so, I'm a fixed income investor, and I see a lot of value in fixed income. I think yields being as high as they are is a real inducement to get involved. I like the carry. I like the income. What you're also seeing is opportunities in the emerging market space, right? So, EM has kind of been left behind, I'd say, the past couple of years. But if you look at where the growth is coming, some of the disinflation really benefits emerging market economies more so. And you're seeing these programs come in for the more challenged countries that lifts up EM as well. So I kind of see it more broadly across fixed income, but EM is definitely a spot of interest.
Greg, when you take a look at some of the pricing action that we've seen within the bond market, specifically just the moves that we've seen in yields, we've been placing so much emphasis on the movement to the upside, obviously, in the 10-year, how likely it is that we're going to get to that 5% level. Is that almost a sure thing at this point when you take a look at the fact that the movement is still, in most cases, here to the upside most recently?
I don't know if it's assured, but I do think it's a distinct probability and possibility. So, our range this year was 380 to 460 on the 10-year. We obviously pierced that. So we do see a real possibility of hitting a 5% on the 10-year. But I would say that's still a pretty decent level. And what we really like about fixed income in here is if and when the economy does start to slow down, we'll see some rate benefit as rate moves lower, and you get that capital appreciation.
Greg Peters, who's the co-chief investment officer for PGIM Fixed Income. Thanks so much for taking the time here this morning. Really appreciate it.
Thank you.
Coming up, turmoil continues over the future of Paramount. Details surrounding interim leadership and its proposed Skydance deal are coming to light. We'll discuss what comes next with Brian Seltzer after the break.
Paramount shares rallying on reports that the Redstone family and Skydance Media have both offered concessions to make the deal a bit more appealing for investors. Now, the Journal also reporting over the weekend that Paramount Global Chairman Sherry Redstone has lost confidence in Paramount CEO Bob Bakish, and he could be pushed out as early as today. For more on this, we want to bring in Brian Stelter, Vanity Fair special correspondent. Brian, it's great to see you. So talk to us just about where things stand today and then the possibility of removing Bakish here at this standpoint. Just to what extent does this, do you think, maybe potentially further clouds some of those deal prospects?
Yeah, this is late stage legacy media at its worst. Bob Bakish has been in charge of Paramount for a number of years. He has been trying to guide this, very leaky ship into a calmer waters, and it's just not happening. He has lost the confidence, lost the faith of controlling shareholder Sherry Redstone. And ultimately, this is all about Sherry Redstone and her desire to cash out. That's where this story starts. She was the heiress to this media empire that has seen much better days, and she has decided she wants or needs out. It all goes back to when Paramount stopped paying a dividend, and that dividend was basically bankrolling the Redstone family. So she wants her $2 billion or roughly that amount through this complicated transaction. And right now, it's hard to say how normal shareholders are going to come out. I mean, look, full disclosure, I'm a shareholder in Paramount. You just put up those charts. They are painful charts. This is a company that has seen its stock price fall by more than half in the last year or so. So what this means for average shareholders, I think it's too soon to tell, but it's going to be incredible later today if Bob Bakish is fired as expected, and then after the bell, we're going to see Paramount's earnings report without even having a CEO there to present the earnings report this afternoon.
Who is the most likely suitor? Who is the best suitor from your perspective for Paramount?
Listen, it does seem as if David Ellison's Skydance is the leading contender. Right now, we know they're in an exclusive phase of negotiations to make a convoluted deal, to take control, to add equity to the company. That would seem like a very positive development for Sherry Redstone. But again, I don't think we know exactly. We don't have a lot of clarity about how this is going to affect average shareholders. So we see the stock up 6% today. But if you've been in this company for years, you know how far it's fallen. The glory days of MTV and Nickelodeon and Comedy Central. Can those days ever come back? Probably not. I think there's a lot of curiosity about what David Ellison would do. How would he unlock value? There are reports that he would bring in former NBC Universal CEO Jeff Shell to run the company day to day. But what exactly would they be doing differently, so differently than Bob Bakish? I think that's ultimately the question mark here. There are reports that Bakish has lost the faith of Sherry Redstone because he couldn't get certain deals done. There was talks about selling off Showtime, talks about selling off BET. Those deals didn't materialize. So perhaps Sherry Redstone's fed up with Bob Bakish and deciding just to cut off all ties. But seriously, who has a better plan for late stage legacy cable bundles? I'm not sure.
Yeah, Ariel Investments was out with a letter here this morning, or over the weekend, I should say, just talking about how rare this situation is with Paramount. Brian, similar to what you were just saying that the recent dramatic devaluation of Paramount shares as a result of market concerns surrounding an unconventional sale process is a situation that we have never seen before. And this is coming from someone, John Rogers, who has been investing for 40 plus years. So really just speaks to the uniqueness here of this situation. Brian, my question to you is, if a deal doesn't materialize, what happens?
Look, this is all about that dual class share structure, as you're indicating, right? Because Sherry Redstone has so much control, normal shareholders sometimes feel like they're getting the bag. It happens as well at Fox and News Corp with the Murdoch family. What happens if a deal doesn't materialize? There are reports about other potential suitors like Apollo, but one way or another, I think the only thing we know for sure is that Sherry Redstone has made up her mind. She wants out. She will find a way, one way or another, to cash out of this business because she believes it is in an absolute decline, maybe even a spiral. But at the same time, she has to convince a buyer that there's a real opportunity here, real potential through a streaming service like Paramount Plus, et cetera. So if there's no deal right now this spring, then it raises questions about Comcast, raises questions about WBD, Warner Brothers Discovery, and whether there's some sort of combination. That's, of course, the giant media merger guessing game of 2024. In what combination will these subscale streaming services combine? It's going to happen one way or another. We just don't know how yet.
What should customers expect if we do see any of this happen, whether Paramount has to continue to try and find some type of suitor, and as more time goes on, it seems like the deal price might continue to go down or trickle lower. So at the end of it, there's still going to be the customer that's trying to figure out, okay, what is the service level agreement now that I'm going to get guaranteed to me?
Right. It's funny because the history of media is all bundling and then unbundling and then back to bundling and then unbundling again. Right now, we're heading back toward the bundling phase. But as these phases happen, think about who sometimes can come in and be the insurgent, be the upstart, be the beneficiary. 10 years ago, it was Netflix that scared the bejesus out of Paramount and every other major media company. Netflix is still the colossus, the biggest player now in the industry. But as we see these phases, you might think about who can take advantage of what is now the rebundling phase. Who are the winners in rebundling as it happens? Probably not consumers, I would venture to say, because right now these streaming platforms, they say they're losing money by making all these shows. The only way to make up that money is going to be to charge more. And we're already feeling that. I know you all are probably feeling that in your credit card bill, just like I am. I'm paying for Paramount Plus every month and then forgetting to watch anything on the platform. And that's just not sustainable.
Brian, real quick, while we have you, I'm curious just to get your thoughts just overall on the ad landscape, especially on the heels of the results that we got out from Google after the bell last week on Thursday. It really points to the fact that maybe the landscape is recovering maybe a bit faster than Wall Street had anticipated. Is that your sense too?
That certainly is true on the television side as well. There's underperformance in the TV ad market that hurt the shares, it hurt the performance of companies like Paramount and Fox and WBD. There is a sense of some strengthening, but I don't think necessarily as strong as what we saw from Meta, from Alphabet. You know, this is a winner-take-all environment, and those digital players do take almost all. But still, around the edges, a strengthening TV marketplace is great news heading into the upfronts. Those are in May. That's when ad companies make their advanced purchases of TV ads. And so those are good signs for the likes of Paramount and Fox and Warner Bros. Discovery.
Brian, good to catch up with you. Brian Stelter, Vanity Fair special correspondent. Appreciate it as always. Thanks. Coming up, everyone, a headwind for stocks. We dive into what a recent jump in Treasury yields means for the broader markets. That's next. A strong slew of corporate earnings driving the S&P 500 to its best week since November last week. According to FactSet, 46% of companies have reported Q1 earnings so far, 77% of them beating profit expectations. But overall, the S&P 500 has taken a breather in April, off about 2% over the past month as investors reprice rate cut expectations for the year, and several Wall Street strategists say high rates remain a key headwind for stocks. Yahoo Finance's Josh Schaefer joins us at the desk with more. Hey, Josh.
Yeah, Brad. So when you take a look at sort of the market action over the past couple weeks here, I think there are some things you'd see in earnings that make you think that the index might be higher than it currently is. I'm thinking of perhaps the net profit margin we've seen from the S&P 500 this year coming in at 11.5%. That's above what we saw last quarter. You take a look at just how earnings have come in general. The index itself is now pacing for higher earnings than what strategists thought 3 weeks ago. So overall, things have inflected better, but we haven't really seen it reflected in stock prices. So sort of what is the key catalyst behind that, right? And it seems to be higher rates. And so several Wall Street strategists out today highlighting how higher rates are impacting stocks. Michael Kantrowitz said that at this point, it's really hard to see equities going higher without rates going down. That's the stance from over at Piper Sandler. And I think it really just stands out to me because we've seen the 10-year move up about 40 basis points in the last month. The S&P 500's down almost 3% in that time. It has been a very clear back and forth as it was last year, which is, okay, stocks are down today. What's our catalyst there? It's yields up, right? And so when you have yields up, we've had stocks down, it's been pretty easy to sort of watch that correlation. And that's also something you've seen play out when you look at something like the 2-year, right? The 2-year yield last year when we hit 5%, which we just got to last week, that's when stocks started to bottom. And that's where we were at over the past week. You can see it in the chart there. The S&P 500 starts to turn negative as the 2-year yield hits 5%. It's a pretty linear thing to look at here and something that a lot of people on the street are highlighting.
You know, it's a bit surprising because you mentioned the fact that we are getting better than expected margins, right? Especially when you compare it on a year-over-year basis. You're also talking about that profit growth outlook, which up until this point has been pretty robust. Obviously, it could change once we get more earnings results here this week. So you could make the argument that that is likely going to support here. Obviously, the market's trending higher despite what the Fed does. But I think the question is to what degree does that movement or the movement higher that we are going to see, and how much of that excitement or how much of that positivity here has already been priced into the market up until this point?
Definitely. I mean, you're trading at, well, we'll get into the valuation discussion here, right? You're trading at a valuation that is very rich. You're talking about maybe 20 times earnings right now. And I saw Kevin Gordon over at Charles Schwab highlighted this morning when the last time we were at 5 years on the, or 5% on the 2-year, we were trading at like 14 times earnings. And so when you're, sorry, that would be for the 10-year, going back to 2007. And so really the market right now is very richly valued, which is why people are saying the one thing that can maybe push us a little bit higher is earnings, but that's normally in the large cap stocks that we're talking about, not necessarily when you go down the cap spectrum. But that is the call still, is earnings can help perhaps individual stock moves, right? It's not to say that it won't help at all, but for us to have some sort of broadening rally where everything gets a bid, it's a little hard to reason that that's going to happen when your 10-year is at 4.6% and only creeping higher.
Yeah, it makes a lot of sense. All right, Josh, great stuff. Thanks. We'll keep right here on Yahoo Finance coming up 10 a.m. Eastern Time, just 4 minutes from now. Our brand new show, Catalyst. We are going to be diving into what is moving the markets this morning. Madison Mills is going to join me to break down what investors should be watching. There's a lot going on this week, including the Fed's decision on Wednesday, plus big tech's issues with China set to take center stage in Apple's earnings this week. We will discuss what investors should expect to hear. Stay tuned because it all starts in just a few minutes. We'll see you then. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and welcome to our brand new show, Catalysts.
From equities to commodities, we are decoding trends and uncovering the drivers behind today's market moves.
Our team of experts are here to help you navigate all possible outcomes to make the best decisions for your portfolio.
It's Monday, April 29th, so let's dive into the catalysts moving the markets today. The Fed's latest decision is out on Wednesday, and investors will be listening closely to see if Fed Chair Jay Powell is signaling cuts, a pause, or even further hikes to come. The FOMC is widely expected to keep rates unchanged for the 6th consecutive meeting.
And China is still a big problem for the Mag 7 laggards Apple and Tesla. Competition for EVs is heating up in the world's second largest economy, leading to a pricing war with Tesla at the center of it. But CEO Elon Musk did gain a huge victory over the weekend, a surprise chip to China, leading to a crucial approval for the company's self-driving technology. Meanwhile, Apple is set to deliver earnings this week, giving investors a closer look at how slowing demand in China is impacting the tech giant's bottom line.
And a real-life succession story playing out before our eyes. Paramount Global still embroiled in messy media merger talks. Now things expected to heat up even more as the window for exclusive merger talks with Skydance Media, that closes on Friday. Rumors swirling about the possible ousting of CEO Bob Bakish as soon as today.
But first, the big story of the week, and that's the Fed's rate decision. While the timing of the Fed's first cut is front of mind for investors, could stubbornly high inflation and a strong economy add another wrinkle, further hiking? We put that question to economists and strategists here at Yahoo Finance, and here's what they had to say.
We are set up for them to cut this year, and probably more than once.
If the data are making a clear case for cutting rates or raising rates, for example, the Fed would do so.
A raise? You think they could still raise?
I don't think that they would.
If inflation is, persisting into the second quarter at a rate above 3%, absolutely they should be very seriously considering more hikes.
So let's talk about what you should be watching from this week's meeting. Joining us is our very own head of news, Miles Udland. Miles, I think the big debate out there, obviously, when you take a look at the recent data prints that we've gotten out, especially when it comes to inflation, we're not seeing improvement there. Do you expect much of a change from Powell this week?
Well, I think really the most important thing for investors will be if Powell continues to say the three words, at some point, because that has really been, at this point in the proceedings, what investors continue to key off. We're not having a rate hiking conversation, as we just heard in that package, and it's really because the chair continues in a variety of public settings to say, we believe it will, some version of, we believe it will be appropriate at some point this year to, reduce restriction, right, or to increase accommodation, however you exactly want to finish that phrase. And so as long as Powell continues to suggest that not only is the next move lower, which is kind of a separate conversation, but that it will happen this year, I think there will remain optimism from investors that it will happen. Now, the timing after this month, really after June, gets increasingly complicated, but I think more and more economists are of the mind of, let's just have that conversation when we need to have it, and let's get through June if the Fed indeed does not cut in June, and then we can worry about the politics, the election, the timing, all those sorts of issues.
Sometimes, though, it's a tale of two Powells in the meeting. He's tough, hawkish during his commentary, and then in the Q&A, reporters tend to get a little bit more of hawkish commentary out of him. What do you think the market will do if we get those two Powells on Fed Day?
I think I will be surprised if Powell doesn't. He's spoken twice since the last FOMC meeting, so he's said a lot. And I think given what we saw in Friday's PCE print, I will be surprised if he sounds really any different, meaning that he will continue to back up this notion that there will be cuts at some point this year. And while there may need to be some patience from investors who wanted the 6 cuts, obviously that's not going to happen unless you get a 50 basis point cut, et cetera, et cetera. I think you will continue to see most of what we've heard from Powell, given the volume, again, not just of Fed speak in general, but from the chair specifically that we've seen since the last meeting.
Miles, how do you think this sets up the pricing action that we could see? Because obviously you have so much focus placed on the Fed, exactly what we're going to be hearing from Powell. But then you've also got another huge week when it comes to earnings, exactly what we are going to see there. And at least up until this point, it has proven to the fact that earnings remain strong, coming in better than expected, and it has been enough to keep this market's momentum to the upside.
Yeah, I think all else equal, I think investors would prefer to care about earnings more than they would prefer to care about the Fed. And I know there's some data going around that this has been a quarter where you've seen companies punished for missing earnings, and they have not necessarily been rewarded at the same pace that they were in previous quarters. But in general, you kind of saw last week the theme coming through that investors they basically want to root for the corporate story more than they want to care about the Fed story. Because there's a version of the Fed story where it's going to be 8 straight meetings. So almost, it's going to be a year that we've seen rates held at this level. And I think investors have made their peace with that. They made their peace with that really last summer. We saw the rebound from the rise in yields in the fall. There's been a lot of comfort that, okay, in a perfect world, I would rather not the Fed funds rate be at 5 3/8. But if it is and it's going to be steady to lower, we can be okay with that, so long as profit margins, which are now kind of recovering just a little bit, look better. So long as you continue to see, the generically phrased corporate fundamentals continue to improve. That is ultimately what equity investors want to see more than anything else. I think the Fed is easier for us to talk about, and I think that's why it gets so much play. But for the investors, the investor audience, specifically the investor class, they want to talk about earnings, and you start to see glimmers of what people are focusing on last week, and I think you'll probably see that again this week. But what do I know?
Well, there's more to talk about with earnings too,
like
you said.
That's why we have you on. We're kicking off the brand new show, Catalyst.
As I'm talking, I realize I'm saying the market's going to do, implying it's going to do X, Y, or Z on Wednesday. It's I don't know.
It's one potential
Markets go up, markets go down.
Exactly.
We're going to wait and see what
I think
happens.
if it does nothing, that's the perfect ideal, right? The platonic ideal of market reaction to the Powell.
There you go, platonic ideals. Miles, thank you as always for bringing the fun to our brand new show here. We really appreciate you. Stocks continuing to climb higher as investors await not just that next decision from the Fed, but any signals from Chair Powell about rates for the rest of this year. Stocks holding on to last week's gains with the market buoyed by big tech earnings, focusing on company news rather than economic data showing stickier inflation. So given this backdrop, how should investors be playing the Fed decision? We have Jordan Jackson, JP Morgan Asset Management Global Market Strategist, right here with us. Jordan, thanks for popping in during that smooth transition there. I really appreciate it. I know you just heard Miles talking a little bit about how the market wants to kind of ignore the Fed, move off of tech earnings. But for those in this market who are paying attention to the Fed, how should they be positioning themselves ahead of this week's meeting? What should they be thinking about and doing differently?
Sure. Well, I think there's real risk that the Fed's not going to be able to cut rates at all this year. One, when you look at, and I tend not to focus on the year-over-year numbers on inflation, but when you look at 3-month annualized run rates, they're super core services ex-shelter inflation. That's running at 8.2% on a 3-month annualized basis. When you look at the labor market, right, we're adding roughly 275,000 jobs on a 3-month moving average basis. If we get to a level of around 150,000 jobs and fall below that, that will put upward pressure on the unemployment rate. But right now, we've got job growth that's putting downward pressure on the unemployment rate. So these are, and obviously the Fed targets labor markets and inflation, and these are just dynamics in which they're not in a position to be able to cut rates. I also don't think they're going to want to cut rates so close to the election. If you look historically, they have cut rates within 2 months of the election 3 times, 84, 92, 08. In 08, we were in a recession. In 92, these were continued cuts as a result of the 1990-1991 recession. And then the 84 cuts was a reflection of inflation having surged in the first half of the year and then began to stabilize in the second half. So you can explain away economic reasons, why they'd want to cut rates. But if this data continues to deliver the way it's been delivering over the first quarter into the second quarter, and then we're now into the election season, I think at best they may be able to squeeze a cut in December.
And if they hold off on rate cuts until December, maybe not even cut at all, like you were saying, is the other possible scenario here this year, what then do you think 2025 looks like?
I think it looks like shallower rate cuts potentially. Now, obviously, if something breaks, they're going to cut rates more aggressively. But right now, we're probably looking at somewhere between 3 and 4 cuts over the course of 2024, and I'd argue that number is getting 2025, excuse me, and that number is getting dialed back a little bit.
How big of a risk is that then to the stock market, particularly given that a lot of these large cap companies, they don't have to worry that much about higher for longer because it's the small caps that have a lot of debt that they're going to have to worry about refinancing. So what is the extent of the potential downside in a higher for longer environment?
I think equity markets can stomach it so long as we're still talking about cuts and not talking about hikes. And the Fed seems committed to wanting to embrace cutting. If you actually look historically in the modern Fed era, let's say going back to 1980, they've never been on a prolonged pause after hiking rates and then went back to start hiking rates again. They've always delivered a cut to some degree. So I think there's still this sort of implicit as well as explicit bias via the dot plot to want to begin to start cutting rates at some point. But crucially, in a higher interest rate for longer environment, earnings becomes that much more important. And one of the things that we've observed is that, obviously Mag 7 earnings growth were very, very strong last year. They're expected to decelerate, but the rest of the markets expect earnings growth is expected to converge upward. And I think that's really, really important.
I'm curious what you've made out so far, just some of the commentary that we've gotten from executives on earnings calls this earnings season when it comes to their expectation that the Fed is going to cut. Yet when you take a look at what the market is pricing, even when you take a look or listen to what Fed Chair Jay Powell has been saying, it seems it's actually becoming less and less likely, to your point, that the Fed is going to cut. What kind of pressure does that put on the fundamentals of the businesses, and then ultimately the pressure that could, I guess, put on the broader equity market then down the line?
To some degree, it cuts both ways, right? Because you look at these big companies, these large tech companies, they're sitting on a lot of cash, and that cash is yielding them something. So it's actually generating something positive for the businesses. And that's why you've seen a lot of talking from the forward guidance about CapEx picking up, spending intentions beginning to improve, which is a very generally I argue supportive backdrop for equity markets. But on the other end, as you've highlighted, small cap companies are sitting on a lot of debt. They have about 40% of their debt is floating rate, so they're very, very sensitive to this interest rate reset. And so they're probably going to be dealing with a little bit more challenges, which is why we skew our portfolios to be a little bit more defensive, a little bit more larger cap in nature in this higher for longer dynamic.
Well, going off of the earnings conversation, we are halfway through this first quarter earnings season, and I'm curious about how you're viewing what we're hearing specifically about inflation on these earnings calls. I think about Walmart executives saying that prices for the first time since COVID are looking similar to 12 months ago. Do we buy that? Do we buy the commentary about inflation waning and a strong consumer?
I'm not so convinced that inflation, where this disinflationary trend is going to magically play out. I've always been of the opinion, if you are a consumer, inflation is your foe. If you're a business, inflation is your friend, right? It's sort of a reflection of pricing power that you have. And particularly in an environment where consumers are spending, the unemployment rate's low, the economy is still strong. I know the headline GDP number wasn't great, but when you look at real final sales to private domestic purchasers, so that strips out inventories and exports, the economy grew over 3% in the first quarter, right? And so I think this is a potentially demand-driven pricing power that businesses have, i.e. they can still raise prices modestly and still have people come through the door and buy.
So given the demand trend that you've been talking about there, given the patterns that we've seen, the trends so far this earnings season, and also obviously coupling that with the Fed and the expectation there, where are you seeing the most opportunity to put money to work today?
Yeah, sure. So we actually like sort of energy in this environment. We think there are some risks that potentially oil prices could move higher in the near term, but we like energy. They're being much more shareholder friendly. It's not just drill, trying to be a little bit more efficient with their balance sheets. I think that's important. Even looking at tech is still, I think actually could be a little bit more defensive this time around. I'm going to keep in mind, we got
even the Mag 7 names?
Even the Mag 7 names, strong balance sheets. Oh, and by the way, a couple of them have just started issuing dividends. Right. We haven't seen that. We've never seen that, right? So I think these business models are changing. They're becoming a little bit more mature, but they're also still investing in a big way. So again, still kind of leaning defensive. We like pockets of healthcare, consumer names, consumer-driven names as well. And then I also think another interesting sort of maybe second derivative, if the AI craze is real, and we know it is, it's here, I think we should maybe start to think about the electricity uptick that it's going to demand. So electricity providers, power grid infrastructure players, I think that could be a really interesting way as sort of a second derivative play on the AI theme.
And then slowly starting to get more and more attention there from the street just in terms of investment opportunity down the line. Jordan Jackson, great to have you here on set with us. Thanks so much for coming in and joining us this morning.
Thanks for having me.
All right, well, switching gears to another big story that's on our radar, and Paramount's messy merger. Shares of the media giant are climbing higher this morning, up just about 3.7% as merger talks with Skydance heat up, and CEO Bob Bakish is reportedly on the outs. All this as Paramount is set to report earnings after the bell today. Standing by with the latest on this saga, our very own Alexandra Canal. Allie.
Hey, Shauna, that's right. Now, Paramount Global has long been rumored as a potential acquisition target due to its small size relative to competitors, but reports have swirled as early as 2016 with telecom giants, including AT&T and Verizon, eyeing a potential merger. We also saw tech company Apple, who looked to acquire Paramount's studio business ahead of the launch of its streaming service, Apple TV+. Even Netflix was reportedly interested in a deal with TV series like Yellowstone and movies like Top Gun Maverick. Maverick, really making a splash with consumers. But talks really began to escalate at the end of 2023 when Axios first reported that Paramount and legacy media competitor Warner Brothers Discovery discussed a potential merger. Those talks eventually fizzled, with media mogul Byron Allen offering a $30 billion bid for the company, while Comcast discussed a possible streaming joint venture. But if we flash forward to today, there are two potential deals that really stick out: Skydance Media and Apollo Global. Paramount is nearing the end of its 30-day exclusivity window with Skydance after rejecting two separate offers from Apollo. The private equity firm reportedly offered $11 billion for Paramount's studio business, followed by a $26 billion bid for the whole company. Now, Paramount shareholders much prefer the Apollo deal, given it guarantees a cash payout. Although Shari Redstone, who serves as the company's controlling shareholder, she seems much more interested in making a deal with Skydance. So a lot of back and forth here, and this comes just ahead of the company's first quarter earnings results set to be released after the bell tonight. Paramount CEO Bob Bakish is not expected to be on the call after the Wall Street Journal reported the executive could be ousted from his position as soon as today. Paramount did decline to comment on the report, although shares are up today, as you're seeing up about 4%. So a lot going on here, but we're going to continue to track this as the saga continues to unfold. Shauna, Maddie.
All right, Allie, thank you so much as always. Really appreciate it. I should mention that Apollo is Yahoo's parent company as well. We're going to do a final check of the markets here, sponsored by Tasty Trade. Looking at green across your screen with the S&P up 0.3%, the tech-heavy Nasdaq up about 0.3% as well. Just taking a look at the biggest gainers on the day, we're seeing that Tesla is holding on to its gains, up over 10% off of that news about Elon Musk's successful visit to China, preliminarily, of course. Looking at SMCI up on the day as well, heading into some tech earnings, seeing that Apple is up as well. So seeing some broader gains across some of the big tech names as we continue to see the Mag 7 earnings cycle continuing here. Now, coming up, tech is doubling down on AI investments, but how could this impact long-term growth? We're going to speak with Dan Niles on the other side of this break about all things Apple.
big tech trade is back ahead of Amazon and Apple earnings this week, and it's all about AI. No surprise really there for investors. Well, investors got a first look at Mag 7 quarterly results last week with the reports from Meta, Alphabet, and Microsoft. And the message to Wall Street is simple and it's clear. Spending on AI is not going to change anytime soon. Let's start with Meta. The company now expects to spend as much as $40 billion this year to cover the cost of building out its AI technology. Now, to put that in perspective for you, that jump is far above the $28 billion it spent in total last year, nearly double its average over the last 5 years. Meta CFO Susan Li warning of even higher capex spending next year as the company invests, quote, aggressively. That was enough to send shares of Meta tumbling last week. Following its earnings results, it actually suffered the worst day in 18 months, and you can see that massive drop right there on Thursday morning. Now let's take a look at Alphabet and Microsoft. Yes, they are spending too, but the street didn't take issue with the amount of money that they're putting to work. Microsoft shares actually gained during Friday's trading action, while Alphabet closed above $2 trillion for the first time. Here are the details of their spending. Alphabet spent $12 billion in the first quarter alone, a 91% jump from a year ago levels. CFO Ruth Porat telling analysts on the earnings call that the company's spending reflects, quote, confidence in the opportunities offered by AI. And looking at Microsoft, its spending reached $14 billion last quarter, a 79% rise from a year ago. On their earnings call, CFO Amy Hood telling analysts that demand is exceeding supply. So where do things stand today? Well, shares of Microsoft, Alphabet, and Amazon all climbing higher so far this year, fueled by investor confidence in their future of AI. But as these tech giants pour more and more money into its development, what does that mean for growth? We want to bring in Dan Niles Investment Management founder and portfolio manager, joining us now. Dan, it's great to see you. So let's just take a step back here right now and talk about where things stand when it comes to big tech. Obviously, lots of focus given the outperformance that we saw last year. Some lackluster performance here to start the year with just a few of those Mag 7 names. But the earnings results that we've gotten so far, what does that tell us about this room to run potentially here to the upside?
Well, stocks don't go straight up, and neither does spending. But I think what you can take away from a lot of the commentary is that we're still in the early stages. And if you take the analogy of the internet infrastructure build out and you say, well, Netscape Navigator, first mass internet browser came out in December of 1994. Well, it really took till 2000, early 2000 for that spending to stop. And if you look at Cisco as an example, the quarter before Netscape Navigator came out to its ultimate peak, revenues went up 16 times over that period of time. And to put that in perspective of NVIDIA, their revenues right now have gone from about 4 billion to 24 billion, so up about 6 times. So still, you could say there's a lot of room for growth, both in terms of time, it's not 5 years, and NVIDIA's revenues aren't up 16-fold, they're up 6. And so maybe that's a way to kind of think about it from a trend that we already saw with the build out of the internet.
Well, I want to talk about some specific names here, Dan. I know that you're long on Meta and short on Alphabet, and I'm fascinated by the market reaction we saw to the earnings from those two names here, because Alphabet announcing spending when it comes to dividends, we got a happy market reaction. Meta announcing more capex spending on AI, and we got a negative reaction. What do you make of that reaction? What does that tell you about what the market wants to see from hyperscalers in terms of capital allocation moving forward?
Well, you have to remember the ordering of how this happened. So Meta came out first, and they guided below the street for next quarter's revenues, but then they took up their capex as well as their expenses. Google came out after that, and remember, Meta went down 11%, and Google initiated a dividend, which was great. But if you look at the forward numbers, actually, the estimates across the street actually edged down for revenues for their upcoming June quarter as well. So I think to some extent, Google benefited from Meta going first. And if you look at Microsoft, sort of a similar situation where the stock was up, I think, 2% or so the next day. But again, they came after Meta, and Microsoft's forward revenue numbers actually edged down slightly as well. So the three aren't as dissimilar as they might seem on the surface. But I also think expectations for Google were a lot less. And with Google, don't forget, yes, their AI stuff's going well, but they've also got over 90% share in search. And if you believe these other companies really matter, like OpenAI, for example, or Mistral or Perplexity or any of these other generative AI names, you got to believe that 93% share in search probably starts to drop over time, which is why we're looking at Google from a longer term perspective. And if you believe in generative AI, I think it makes it hard to believe they keep over 90% share. So that's why we're thinking about that more longer term than short term off of any one quarter.
Dan, do you think the results from Amazon later this week, specifically what we're learning about their AWS business, is that going to test some of that market optimism that we've seen?
Well, again, right, Google and Microsoft benefited from Meta, being weak. Amazon's now going to have to deal with higher expectations because of what Google and Microsoft said. So yes, I think you're 100% right. That is going to test it. Don't forget AWS, which is their cloud business, that decelerated from about 40% growth or so back in late 21. It got down to 12% growth in June and September, went up to 13% growth in December. And don't forget, these guys are the biggest. They're about 1/3 of the market for public cloud. People are expecting that number to accelerate again. And so you're going to have to watch that closely. And how does that interplay with what they're going to spend, which we're sure is going to go up. But don't forget, they have this little thing called a retail business, which, given how many packages show up at my door, it's a pretty big business, right? And so you're going to have to look at that and say, well, how does rising energy prices affect consumer demand? Because that really matters. That's where they're getting a lot of leverage from. So I think the quarter itself will be good, but I'm actually more interested, and I think AWS and cloud and AI will be good. What I'm more concerned about a little bit is expectations are pretty high. What will their guidance for June look like in the retail business because of some of these headwinds, like higher energy, higher interest rate, and what's that doing to consumer demand?
Let's talk about that, Dan, because I feel like we're still hearing from a lot of executives on these earnings calls, consumer strength. The consumer is stronger than ever. We've got this. Are you buying that narrative, or do you think there really are some cracks that we're starting to see in the strength of the consumer that could weigh on some of these big tech names?
Well, it'll be interesting to see what McDonald's has to say later this week, because they're reporting results, and their CEO's been out pretty publicly talking about there being some impact at the lower end of the market. And obviously Amazon's more at the mid to high end of the market with their customer base. But yeah, you are seeing some other signs that this is having some impact, because don't forget, the benefits from all those stimulus checks, those are pretty much gone, have been burned through. The savings rate's pretty low. And as we've been talking about for the last month, inflation's still higher than expected. So you combine all of those things, and you would expect to see some kind of pressure. And don't forget, this market's up a lot from where it was back in October at its lows. And so you have to work in valuations into this whole discussion. And so we're trying to think about all of that together, and where do we want to put our capital to work. And so for a lot of these names, we're more likely to be interested after they report results and we see what ends up happening. And we're being a lot more cautious going into them, because there is big ramp from October for these stock prices, and expectations are high. And if you think about the big three that just reported, Meta, Google, and Microsoft, estimates across the street for revenues actually edged down for June relative to March when you look at just the fundamentals and you forget about how the stocks moved and who came first and who came second when they reported.
Dan, let's talk about Apple. I haven't gotten your thoughts specifically on that name yet. You talk about fundamentals here. You talk about underperformance of some of these names. How does that set up a name like Apple heading into the print that we're going to get later this week? And then ultimately whether or not it could potentially be a buying opportunity or not?
Sure. I mean, I think today you're seeing an upgrade. And so you're seeing the stock go up, because in general, you have sort of the short term. So what's the short term? Well, the good news, if you're bullish, is that they've lowered numbers for the last 4 quarters in a row for the outlook, and everybody's expecting them to lower revenue estimates for the June quarter relative to where the street is. So at this point, expectations are pretty darn low, and we've seen all the numbers coming out of China. Their iPhone market share looks like it continues to drop as you've got combination from Huawei. So that's the good news. And you've got, looking out, you've got the Worldwide Developers Conference coming in June. And obviously there's headlines about, well, is Apple going to be working with Google or somebody else OpenAI to get AI onto these smartphones, which hopefully gets some people to upgrade. And so those are the positives. The negatives is, if you look at it over longer term, competition from China is not going away. They're late to AI. And unfortunately, you're paying a pretty high PE multiple at 25 times for a company whose March quarter revenues that they guided to is exactly the same as it was 3 years ago. How many other large cap tech companies have revenues that haven't grown over 3 years? Very short list. Right. So I think you have to look at short term, sure. Do we think the stock could go up into that June Developers Day on AI optimism? Sure. But with that kind of multiple, with rising competition, longer term, I think you got to be a lot more careful with it.
Dan, real quick, long term, how big of an issue is Huawei's increased success in China for Apple?
I mean, if you look back at our posts, we've been talking about this since Huawei came back. And remember, Huawei didn't have a new flagship phone since 2019 when sanctions got imposed on it. Then in late 2023, they came out. And don't forget, these guys were challenging for number one market share around the world with Samsung back in 2019. They have rapidly gained market share ever since launching their new phone with their own chips, no US chips in them. And that market share continues to grow. And that's the problem with Apple. It's not a China issue, it's a competition issue. I mean, those are two very different things. And so I think you're going to see that continue. And it's not just Huawei, it's the fact that a lot of the high-end phones have AI already in them, like the ones from Samsung, which is the biggest in the world in terms of building smartphones. Right. The foldable category is also doing very well. Apple doesn't have a foldable phone. And so those are other things that you have to think about over the longer term.
Yeah, big headwinds ahead for Apple still. Dan, thank you so much for joining us. Really appreciate your insights. That was Dan Niles, Niles Investment Management founder and portfolio manager. Now, coming up, we've got another big week here for tech earnings. Magnificent Seven members, Apple and Amazon, seeing gains out of their quarterly reports this week. But what catalyst could send shares to the downside? Potentially that big China question mark that we just discussed. We're going to have more on that after the break. Big tech in focus as more members of the so-called Magnificent Seven set to report quarterly results this week, with Apple set to release their results on Thursday. The big issue for Apple? China. The iPhone maker struggling in a region with a resurgent Huawei taking market share amid difficult economic conditions squeezing device sales. For more on China's direct impact on Apple, we have Yahoo Finance's Akiko Fujita. Akiko.
Hi there, Maddie. Yeah, how much of this is really going to affect Apple is certainly going to be a big question here moving forward. The struggles Apple's faced in China clearly reflected, though, in that near 20% drop in sales for the tech giant, even as smartphone sales with China actually continued its recovery. Now, China remains a critical market, as you mentioned, for Apple, both for revenue and its supply chain. Greater China is right behind Europe in terms of sales, with the region accounting for roughly 20% of its global revenue here. And while Apple has slowly started to reduce its reliance on the world's second largest economy, 156 of its 465 manufacturing sites used by Apple suppliers, that's roughly 34%, were in China last year. And that's according to a list that the company released just last week. There are three key issues that could continue to alter this dynamic, though. Number one, the reemergence of Huawei. You guys were just talking about that with the previous guest there. US-China tensions also a big concern, as well as a pullback in Chinese consumers at a time when we have seen growth slow in the world's second largest economy. Huawei's recent success with the release of its premium smartphone has already started to chip away at Apple's position in the market. Counterpoint research found Apple now accounts for roughly 15.7% of China's smartphone market. You compare that to near 20% it had during Q1 of last year. More concerning for Apple, Huawei right behind it on that list there. Last fall, you also had reports of government agencies, state-backed firms banning iPhones from employees. So there's certainly a number of headwinds that have really been building for the company. Publicly, CEO Tim Cook has said he's committed to China, but Apple has been laying the groundwork to diversify its footprint in the region for some time. Just a few weeks ago, Cook traveled to Vietnam, Singapore, and Indonesia to meet with top officials there to explore additional manufacturing posts there. Apple's also been expanding in India, but guys, China is such a lucrative market for Apple. Tough to see that market being replaced with any others, at least in the near term.
Yeah, Kiko, when we talk about the importance of China for Apple, we also got to talk about the importance of China for Tesla, because that is another name that's on our radar here today. It's another Mag 7 stock that is facing some steep competition within the country. CEO Elon Musk making a surprise visit over the weekend, speaking to officials about autonomous vehicles. Talk to us just about the significance of this and whether or not it's a game changer for Tesla.
Yeah, I mean, it's interesting, by the way, he met with a number of officials during this 24-hour trip. The now premier of China, Li Chang, top official over in Shanghai that approved the Shanghai factory for Elon Musk. So he's clearly got an in there in China as well. Now, whether this is in fact a game changer, we heard Wedbush's Dan Ives saying that this reported approval of full self-driving software in China for Tesla is a golden opportunity. Probably too early to say how significant it's going to be for the company, largely because there's a lot of Chinese EV makers that have been chipping away at their own self-driving technology for some time now. In many ways, the market is sort of necessitating this for Tesla. They've got to have this technology in place to be able to compete in such a crowded market. Here's a number to leave you with, though. When you think about Tesla's share of the Chinese car market, that was at 6.7% in the fourth quarter of 2023. You compare that to 2.5% in the first quarter of last year. So that's also slowly been shrinking. Of course, the key is going to be what the price point will be for this software, if in fact it is deployed in China. And the backdrop, all of this, is that they are coming off of their worst quarter in 2 years.
All right, Akiko, thanks so much for breaking that down for us. We want to talk a little bit more about Apple and Tesla in China. First off, taking a look at Tesla, Elon Musk's 24-hour trip to China pays off, at least for now. Tesla receiving in-principle approval to roll out its driver assistance service in the country. Now, the deal is seen as a potential catalyst for sales growth following Tesla's slump in China, which is Tesla's second largest market. The stock moving to the upside on the news of this today, rallying up just about 11%. For more, I want to bring in Leland Miller, the CEO of China Beige Book. Leland, it's great to have you here. And Akiko was just laying out some key stats, I think, and just really highlighting Tesla's shrinking market share that we have been seeing now over the last several quarters within China. When you take a look at the news today and given your expertise within the region, is this a game changer for Tesla? What do you think reception is going to be like towards Tesla vehicles within China?
I think it's too early to call it a game changer. What Tesla certainly has to do is stay on the forefront of innovation. They have to be the most technologically advanced car option because they can't compete on price because of the dynamics of the Chinese market. You know, you've had over a decade of mass incubation of a very advanced, very impressive electric vehicle market in China. What you've gotten now is a situation where you've got so many cars and you've got a domestic car market that's mostly saturated that there is a price war going on. And the price war is going to drive exports to other countries. This is why a lot of governments, the United States, EU, are worried about overcapacity, et cetera. But it means that the prices are being driven down, down, down. Tesla needs to make a profit, unlike a lot of these Chinese firms. So it can't compete in an even field. It needs to stay on the top of the technology ladder. This allows it to stay on top for a little while longer.
Leland, was this trip more beneficial for Tesla or for Beijing?
Well, I think, you know, it was advantageous for Beijing in that if they didn't see an upside for China, then they wouldn't give Musk the approval that he's been getting. So Tesla just agreed to a mapping deal with Baidu on navigation. It agreed to get some regulatory approvals in terms of data security and in terms of some other things. So China obviously sees this as important. But again, it's what does Tesla bring that other Chinese car companies don't? As long as it's pushing the envelope for technologically, I think Tesla's in solid shape. But again, they can't compete on price. So there are enormous pressures on Tesla right now in China that weren't there a few years ago.
Leland, let's talk about what we're seeing here from Apple, because when you take a look at sliding demand, at least the recent numbers that we've gotten out, we'll get a better picture on it later this week, but the slump in demand that we're seeing of Apple's products within China. Talk to us a little bit more about the current sentiment right now towards Apple's products and whether or not we're seeing this secular move away from Apple products within China.
I think we are seeing a secular move. I mean, you have pressure from the supply side and you have pressure from the demand side. Demand side, the government doesn't want many of its employees using Apple. There's either formal bans or informal bans on using Apple devices within government. You have a movement away from foreign phones. You've got these great advanced options domestically at Huawei and others. So there's more of a nationalistic sentiment towards buying Chinese technology. So all these are pressures on the demand side. On the supply side, Apple's been getting enormous push to extricate itself as much as possible, or at least its reliance on Chinese supply chains, and not extricate itself completely. So you've got pressure on the supply side that's raising costs. You've got pressure on the demand side. This is a very difficult situation for Apple as well.
Right, and we know that China accounts for about 20% of Apple's overall sales. What happens if the competition that we're talking about with Apple coming out of China leads to Apple's China sales hitting zero?
Well, look, I mean, you could see something like that happening in a full-blown confrontation, but it doesn't have to hit zero to cause enormous pain to Apple. What you're seeing right now is the result of a lot of trends, but most of them go all the way up to the geopolitical. And as long as you have a situation where there's de-risking and technological decoupling between the U.S. and China, you're going to have a harder time for U.S. companies, U.S. tech companies operating in China, whether that's Tesla, whether it's Apple. So Apple has just a lot of pressure on it to be able to secure alternative supply chains, to be able to make its devices attractive again in China. I think that's going in one direction right now, unless they release some sort of brand new technology that wows everybody. So there's just a lot of secular trends pushing against Apple being able to resist, to push back against losing market share.
Right. All right, Leland, we got to leave it there, but thank you so much for joining us. Really appreciate it. That was Leland Miller, China Beige Book's CEO. Now, the Japanese yen just touched the weakest level against the dollar since 1990. That prompted Japanese authorities to intervene to support the yen. That is according to the Wall Street Journal. Now, why should American investors care about what's going on with the BOJ and the yen? Yahoo Finance's Jared Blickery is here with more. Jared.
The short answer is a global marketplace and everything influences another. And sometimes you get to a tipping point, and that may be where we are with the yen right now. Now, this is the US dollar versus the Japanese yen, and the US dollar has been appreciating. So a higher amount means the US dollar is gaining. That means the yen is weakening. And this level right here corresponds to 160. We haven't seen this level since 1990. As soon as that hit, there was a lot of selling in this particular pair, came all the way down, and it's been a bit volatile, as you can see here, but huge trading range. I should point out that this is a holiday in Japan, so we shouldn't put too much stock in it. Very illiquid markets. Not surprising this happened, but all of this speaks to the bigger picture. Why does this matter for U.S. investors? You got to look at interest rates in context with each other. This goes back to 2008. These are the Fed rate, the ECB rate, which is all the way up here, versus the Japanese rate, which just got positive within the last couple months. If these do not converge, and traders have betting that they will, there could be some hinky stuff in the market. What I want to point out with this chart is that the yen has been following U.S.-Japan interest rate differentials. As long as that gap remains high, speculation about where that's going to go is going to drive the yen. So we could end up facing a moment where stuff hits the proverbial ceiling here, but we haven't reached that point just yet. So the bottom line is there's a lot of focus on the yen right now. It is a holiday. There's a lot of volatility, but we'll have to see if the BOJ does anything when they get back into their office tomorrow.
Absolutely, Jared. And it's a great point that this kind of bifurcation that we're seeing across central banks globally is pretty abnormal. And so that's why we want to take a look at what different central banks across the globe are doing. Jared, thank you so much, as always. It's been a good year so far for the S&P 500, up nearly 7%. But are we amidst a technical correction? We're going to speak to a strategist on what's next for the market right after the break.
Stocks pushing to the upside today as the S&P 500 comes off its best week since November, where we are trading right now above 5,100. We're just about 3% shy of record highs. Well, despite that move to the upside, though, our next guest is warning the equities may be set to actually lose momentum from here. We want to bring in John Kolovis, Macro Risk Advisors, Head of Technical Strategy. John, it's great to see you. So you have a number of charts that we're going to be putting up here in our monitor that you are going to break down. But first, just talk to us just about the momentum that we're seeing play out in the market. We've seen the S&P break above that 5,100 level. Doesn't sound like, though, you think we're going to remain at these elevated levels. Why?
Yeah, thanks for having me. So first things first is, it's the nature of how the market declined that has me a little bit concerned. When the market peaked in early April, it started to have this cascading event of selling begets selling. And what I mean by that is if you take a look at some of the high profile winners, the momentum winners, the semiconductors, for instance, once those stocks started to break their 50-day moving averages, a bit of a trap door occurred in equity markets where what would be a conventional oversold condition where you want to be, okay, let's buy this and keep getting aggressive. I would almost label it as a bad oversold because selling was a little bit too aggressive on the downside.
Well, let's talk about that downside. And we have a chart here on the corrective pullback with risk to 4,800 that I wanted to pull up for you here, John. I'm curious if you can speak to what we're seeing in this chart when it comes to the potential risk for us to get back down to 4,800 here and what the catalyst might be to push us down to that level.
Sure. So basically what I'm outlining in my notes to clients is that I believe that we are in a correction. This is not a bear market, right? This is just a corrective process. In a lot of ways, you can kind of think of this as the market's working out their excessive bullish sentiment from the beginning of the year. Also, from a seasonal standpoint, this part of the election cycle from mid-April to about June, markets tend to pull back. So kind of par for the course-ish. But like I said, the decline that we saw in April was accompanied by a lot of heavy volume. So what typically transpires is called an ABC correction. A is the initial decline down. B is the oversold rally, which is where we are right now. And then finally, you get the C wave lower. And that C wave lower is where you truly get folks bearish, right? You really see the whites in their eyes. Some of the sentiment data that's been released during this month has gotten better, but I wouldn't go so far as to say that it's really showing signs of capitulation quite yet. In terms of catalysts, I have my eye very, very much closely on what's going on with the Fed and these hawkish macro trends that have been going on all year.
Yeah, John, is that the number one thing you're watching just in terms of sentiment? What exactly is going to be that catalyst from here? Is it what comes out from the Fed and any sort of hints that maybe rate cuts are still on the table for this year?
Yeah, I mean, I tend to focus a lot more on that macro end of things where I try to triangulate my equity call, right? So because if equities lived in a vacuum, it would be a much easier call, and they don't, right? They interact with interest rates and commodities and currencies. And those trends have been negative all year for risk. And it just happened to be the CPI number when the 10-year broke above 4.5%, markets went, oh, wow, maybe we should pay attention to this. And I think that was a regime change in terms of market psychology. So yeah, I am keeping a very close eye on how the market responds to the Fed this week. We also have important economic data as well on the jobs front. We do have earnings. Also, there's a couple of Mag 7 stocks that are coming out as well. But unless we see the S&P and most of the major indices see a sustained move above the respective 50-day moving averages, at a minimum, expect an undercut of the April lows. If not, a move down to 4,800. Which is approximately where the 200-day moving average is trending towards.
All right, so watch that 50-day moving average and hope for the best for our investors listening. John, thank you so much for joining us. That was John Kolovis, Macro Risk Advisors, Head of Technical Strategy. Now we're over an hour and a half into the trading day. Here's what you need to watch for the rest of the day. I'm looking at whether or not big tech earnings can keep this momentum going. We have Amazon kicking off earnings for the tech sector this week. The report is out tomorrow after the bell. And Shauna, we've been talking about this with a lot of our guests, the idea that the Fed is the B plot for this week, that these big tech earnings are critical to watch. And Dan Niles mentioned this earlier. He talked about how earnings for Google and Microsoft did set the bar a little bit higher for for AWS, particularly because there's this question about how much cloud demand there is going to be and whether or not that demand is a pie that's just growing and there will be more room for all of these players to snack on that, or if Google and Microsoft are kind of taking a bit of the pie from Amazon. So that is going to be critical to watch, along with some of the consumer demand that we saw from Amazon as well.
Yeah, and I think so much of what's going to be interesting, especially what we hear from Amazon AWS, is the spending portion of it too, right? Just in terms of how big of a factor that was last week and some of the action that we saw, particularly around Meta. Yes, very different business models, very different businesses here, but I just think the spending and the plans for spending specifically on AI is going to be something that could really move not only Amazon stock, but also some of the larger players within that space as well. And sticking with the tech theme, we also got to talk about Apple, Maddie, because that was one of my big takeaways today. And we spoke to Leland Miller, the CEO of China Beigebook. We spoke to Dan Niles, a well-known investor, earlier on in the hour, and asked both of them just about their opinion right now of Apple. Yes, we did get that upgrade from Bernstein today. That's why shares are up over 3%, but they both were urging some caution. Specifically, what was coming out from Dan Niles was saying that he urges investors to be cautious in the longer term. He was talking about that high multiple, was talking about rising competition, saying that Apple really has a competition problem, not so much a China problem. That's not only within China, obviously, but Apple in general is suffering from a stiffer competition. And then specifically within China, we were talking to Leland Miller about this, and he was just highlighting the secular move away from Apple within China. I'd bring that up because that obviously can be a pain point here for other big names who rely on China for sales, have a massive presence in China. If we do see any sort of backlash from rising geopolitical tensions, if we do see more dominant domestic players, which is clearly taking place within the tech space, clearly taking place within the EV space when you take a look at Tesla and some of the pressure that has been under there. So I think that should be top of mind for investors, not only today, but as you get ready for some of that movement that we could see towards the latter half of the week.
Yeah, the China story, the geopolitical story continuing to be huge risks to watch. We are going to do a final check of the markets here. It looks like we're seeing some green across your screen with the S&P 500 and the Nasdaq close to 0.3% on the upside here, continuing to go into the green off of that good tech news.
And coming up next, we've got wealth dedicated to all of your personal finance needs. Brad Smith has you for the next hour. He'll be speaking with the CEO of SoFi on the back of its earnings results. Anthony Noto, he's joining Brad next hour. Stay tuned. We'll see you tomorrow.
to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, deciphering earnings reports will give you the tools to understand Apple's upcoming quarterly results and what they mean for you. And jobs are in focus. We're bringing you a week chock full of interviews with commentary on the labor market ahead of Friday's big jobs report. Plus, student loans. SoFi's quarterly earnings show a big year-over-year bump in loan originations. We dig into exactly what it means for high school seniors and those making some continuing education decisions. But first, we take a look at some of the market action. 90 minutes into the trading day, let's take a look at the Dow, the S&P 500, and the Nasdaq, the three U.S. major averages here, as we're seeing all of them kick off the trading week. The move higher comes after a slew of upbeat corporate earnings drove the S&P 500 to its best week since November. We have a ton of earnings this week as well to track, including results from big tech players. Oh yeah, you know them, like Amazon and Apple. We're also tracking the Fed. The central bank is expected to keep interest rates unchanged at its policy meeting this week. Investors increasingly pricing in a higher for longer rate environment. And we're also tracking some trending tickers on Yahoo Finance. Right now, take a look at TSLA shares getting a nice little pop after a surprise visit by Elon Musk to Beijing this weekend. Musk making his second trip to China in less than a year to expedite Tesla's full self-driving tech rollout. Chinese officials reportedly telling Tesla that Beijing has tentatively approved the company's plan to launch its full self-driving software feature in the country. This is according to Bloomberg. Now, this win, it comes as a pivotal time for Tesla and the company looking to strengthen revenue growth and EV footprints around the world. And SoFi shares, we got to talk about that. That's plummeting this morning as a disappointing Q2 outlook overshadows a profitable quarter. The company seeing Q2 revenue between $555 and $565 million. That is below the $580 million estimate. Now, Q2 adjusted EBITDA also fell short of expectations. SoFi did see big increases across the board in loan originations in the first quarter, important to note. And guess what, folks? We're going to dig into the release later on in the hour with none other than the CEO, Anthony Noto of SoFi. Going to join us live, 11:45 a.m. Eastern Time. You do not want to miss that conversation. Well, earnings season well underway, and it's shaping up to be a strong quarter, especially for the S&P 500. Almost 50% of its listed companies reported results so far, and nearly 4 out of every 5 have beat Wall Street estimates, according to FactSet. So, in the peak of the earnings season, where should investors be putting their money in the market? For more on this, we're joined by Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. Joanne, great to see you and grab some insights from you as always. There's a lot of chatter around what this higher for longer rate environment means for the prospect of some of the most crowded trades, namely in tech and the Magnificent Seven. I'm wondering how you're evaluating and running the calculus around this right now.
Yeah, Brad, good morning. Clearly those companies have grabbed a lot of attention and they've done well despite the fact that rates have remained higher for longer. A lot of folks were betting that rate cuts this year would propel those growthier tech stocks, and that hasn't been necessary. And the reason why it hasn't been necessary for those stocks to appreciate in this environment of higher for longer is because of their earnings and their sales. And the results we saw last week only give investors more confidence that many of those companies, though not all, are on track to continue to grow 20, 30% per year for the next few years. And we have generative AI to thank for that, as that really does transform a lot of the ways that companies and consumers will live over the next many years to come.
With all of this in mind, and we were talking about the percentage of the earnings season that we've got past, roughly 50% of the S&P 500 companies have already reported, and last week was one of the busiest weeks of the first quarter earnings season. All of this considered, what is the theme that is really more pronounced and is continuing to be a common denominator from your perspective?
Brad, there's a lot of mixed information coming out of the markets. I mean, some areas of the economy, you'll listen to some companies during their earnings call saying, hey, there's weakness out there. Demand is weak. We are just getting through, or, hey, we are still clearing inventory. So, there is a lot of disparity, and that really does make it important to select individual stocks and not just invest in the whole market. Because the market, by some metrics, is kind of on the expensive side. So you really want to drill down and make sure that if you're focused on growth, if you're a long-term investor and you have a decently long time horizon, there are plays you can still get here, like a Microsoft or an AMD or a Broadcom, but you can mix that in to take into account the fact that there's some rockiness in this economy. And we're a little bit worried about the resilience of the consumer this year after such strong growth for the last several years. And so there are ways to play that too.
And so that is something that the Fed is going to be laser focused on. We came into this year, 5, maybe even 7 rate cuts were on the table from some economists out there. And sure, lofty and as high as that was, we've started to see that be pared back, trimmed back. And for some economists, they're saying, you know what, it might just be December. Or if we see 2, it might be September and then December. For us running our calculations and investors out there that are trying to best get a sense of how many rate cuts we might actually see and what that means for the markets and potentially seeing new all-time highs, even in the face of less cuts than anticipated, do you think that we might actually see that come to fruition where a market can continue to rise despite the Fed not giving the market the anticipated amount of rate cuts, at least at the start of the year?
Yes, our view has been for the last year or so that the Fed was going to stay very focused on getting inflation under control, and that there were dynamics in place, a shortage of labor, for example, that would continue to keep upward pressure on, say, wages, which would feed through into inflation. So the Fed was going to have a hard time cutting rates. We didn't expect what the market did. And on the other hand, though, it does mean that the economy has been pretty strong. More and more people have been getting jobs, and that has supported consumer spending growth. So it's sort of a good news story. Yeah, the Fed hasn't been cutting rates, but that's because the economy has been strong. That used to be a pretty significant headwind for growth-oriented stocks, but what investors have found is that companies can still grow their sales and their profits in a way that raises the value of the company. And so what you have to do is not look at the market as a whole, but look at individual companies with strong demand drivers, that they're in the right place in the market for how the world is changing, whether it's rolling out new software, whether it's NVIDIA and providing the key chips that make AI work, or a ServiceNow that is providing the capability for businesses to deploy AI. So it's really important at this time to look for individual opportunities and not look at the market as a whole.
Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. Joanne, always a pleasure to speak with you. Thanks so much.
You bet, Brad.
Well, with Apple stock down over 10% on the year and news of Vision Pro shipments being cut in half due to the lack of demand, many on Wall Street wondering and they are keeping an especially close eye on the company before their earnings call this Thursday. To help us preview everything that is up in the air, almost as up in the air as me cutting off part of that intro here, Josh Lipton standing by with much more on what investors need to watch here. Josh, what are you keeping an eye on?
So, Brad, we know it has not been easy for Apple investors. So far this year, as you mentioned, that stock is down more than 10%, pressured by concerns about the company's AI strategy, the China business, and, of course, regulatory scrutiny. When Apple reports on Thursday, the street's going to be looking for Q2 EPS of $1.50 on revenue of $90.3 billion. But what will be top of mind for investors in that report? Well, Ben Beharin of Creative Strategies says he is first and foremost focused on Apple's bread and butter, the iPhone. And analysts aren't expecting much, forecasting iPhone revenue of $45.7 billion. That would be down nearly 11% year over year. Beharin says that is due to a mix of factors, including tougher comparisons and, importantly, a shaky Chinese economy. The key is going to be, of course, what Apple says about the outlook for the iPhone business looking ahead. I also caught up with Gene Munster over at Deepwater Asset Management. Now, he is focused on AI. Munster does not expect CEO Tim Cook to say much on that topic. Instead, if he's asked, deferring questions to the company's big software show coming up in June. But Munster does believe Apple is going to outline how much they are spending to build out their AI infrastructure. Not specific numbers, perhaps, but emphasizing that they are going to be spending meaningfully more to better compete in this red-hot area. Now, Munster argues that more AI investment, the better. Will investors agree? Q3? We're going to find out. Also in focus, Apple's Greater China business. Munster thinks revenue in that segment is going to be down 13% year over year. That would be in line with what was reported, remember, for the December quarter. Munster arguing that would actually be a positive, as it would imply business isn't getting worse over there. And he bets the China business returns to growth later in the year on easier comparisons in the quarters ahead. And one more thing. Remember, this is the quarter when Apple typically does update its capital return program. Analysts expect Apple could expand that program by $90 billion. Brad, back to you.
Josh, love a good that one more thing reference there. Of course, what everybody sits on the edge of their ergonomic chairs for when we get the updates and product updates from Apple later on in the year. Josh Lipton, thanks so much. Coming up, everyone, NerdWallet out with its quarterly results. CEO Tim Chen going to be here on the other side of the break to tell us what the company has in store in the coming months. That's next. Let's do a check of the markets, sponsored by Tasty Trade. The Dow, the S&P 500, and the Nasdaq are in positive territory right now to begin the final couple of trading sessions in April. And before we get to some of the employment situation data later on this week, plus earnings, the Dow right now up 0.2%, the S&P 500 holding on to gains of about 0.25% as well, and then the Nasdaq Composite, that too, about the same on a percentage basis, up roughly 0.25%. Well, personal finance company NerdWallet out with its latest earnings report, and we're seeing some mixed results, with declines in the credit card segment being somewhat offset with growth in their insurance and business product offerings. With me now, we've got Tim Chen, who is the NerdWallet CEO, joining us here on Wealth. Tim, great to speak with you as always and grab some of your time here. Look, I was listening in and ultimately reviewing the results here, and one of the huge things that jumped out with the earnings here, I mean, most of your company comes in from referrals, a financial product. Credit card revenue, though, that did fall in this most recent quarter here. Just walk me through the quarter here and what's at play within the consumer demand realm right now.
Yeah, thanks for having me back. Really proud of our results this quarter. We beat our guidance on revenue as well as profitability metrics. And this was in spite of, a pretty tough lending environment and us pulling back brand spend 30% year over year. We grew monthly unique users 25% year over year and reached 20 million registered users. And so to your question, credit card was quite impacted this quarter. So, if we rewind back to March 2023, that's when the regional banking crisis started in earnest. Since then, we've seen bank balance sheets get more conservative, and we've also seen elevated delinquency rates, as well as higher interest rates. So that makes it less attractive for consumers to borrow and also less attractive for banks to lend. And those two factors have really driven a headwind there.
Certainly. How would you classify the consumer right now? We were just having a conversation prior to the break just around how employment factors into consumer confidence because of the wages that consumers are able to see as well, and then redeploy some of that income as well. How would you classify the consumer environment?
I mean, I am like every other consumer. I've been getting utility bills. I've been getting homeowners insurance increases. I mean, the average consumer is stretched, and the most at-risk consumers are the most stretched by inflation. So consumer balance sheets are definitely in a worse spot than they were a year ago. And we're seeing that reflected in things like higher delinquency rates on everything from auto loans to credit card balances. The repayment rates on student loans is not picking up. And so there's definitely some strain out there.
When we hear from places like the Conference Board or University of Michigan, and they're talking about what the confidence or what the sentiment is, it's often coming with this caveat that, hey, if we do see interest rate cuts, well, the likelihood of a perceived recession might be offset by confidence in prospects for wages, for jobs, and just in general comfort for consumers as well. Is it as simple as that? Is it as simple as if we did see interest rate cuts come, that consumers would feel like, okay, I can pay off that delinquent bill right now because I feel more confident about the future prospects?
I think that would help a bit, but yeah, to state the obvious, the Fed is in between a rock and a hard place in terms of helping consumers with inflation remaining high. Big picture, we've got not enough goods and services for the demand that's trying to consume those goods and services, keeping those inflationary pressures up. And that's really showing up in the form of people having to work harder and run on a treadmill to get less for their work.
I wonder what you're seeing on the credit score side of this too, especially with all the data that you're able to really lean into with regard to where consumers are tapping into certain financial products right now.
Yeah, so that's a great question. I mean, we continue to see a tale of two cities. I mean, there's the most at-risk consumers are really stressed, but we're also seeing prime consumers, for the first time maybe 2 quarters ago, start to go down that curve of being a little more stressed as well, but holding in there far better. And so this is still a bit of a divergence between the two sides of America.
Tim, it's always great to grab some time with you here. Look forward to checking back in on the future as well as getting some more updates on what you've already discussed with investors. Tim, thanks so much.
Thanks for having me.
Absolutely. It's Tim Chen, NerdWallet CEO. We've got much more on wealth after the break. You're watching Yahoo Finance. One of the next big reads on the economy comes Friday in the form of the monthly jobs reports. The labor market has proved resilient despite higher prices. A strong labor market bolsters the Fed's argument to keep rates higher. Now, this week on Wealth, we're zooming in on the jobs economy, looking at everything from how businesses are functioning in today's economy to how a 4-day work week could transform corporate America. And today, we're looking at how one consumer-focused business has handled rising prices, plus much more. Join me now in studio. We've got Misfits Market CEO, Abhi Ramesh. Abhi, great to have you here.
Thanks for having me.
Absolutely. Misfits Market is an online grocery delivery service that focuses on making affordable, high-quality food more accessible and reducing food waste as well. I mean, even if people go to the website, it's very clear that your goal, your mission is to really bring down the prices at a time where consumers are thinking more about inflation. Walk us through how you continue to maintain being able to deliver that.
Absolutely. Value is a core part of our mission. And the way we do it is also a little bit different. For us, it's not about just lowering prices and on the website. We have a structural cost advantage. So we are going and sourcing products that other retailers can't buy, won't buy for a variety of reasons. Ugly produce, cans that have the wrong label on them, pasta that's put in the wrong packaging. We're buying that at a discount because other retailers can't buy them, and we're selling them to our customers at a discount. So that supply chain advantage, what we call it internally, is what allows us to maintain our price competitiveness in the market.
How have you also maintained your own cost basis over time too? Because that's also something that you've needed to run the calculus around and make sure that even in your buying of and hopefully, getting a favorable rate, that you're also not increasing the amount of expenses going out the door too.
Definitely. Our model is entirely first party, meaning we own and operate every piece of our supply chain operation. So everything from when we purchase the food to the trucks that bring it into our warehouses, to even the delivery fleet that is delivering these products, we operate all of it. So that gives us an incredible amount of control over cost management. And so, as we've navigated the past couple of years, obviously COVID resulted in a huge spike in demand. We scaled up our operations, we scaled up our warehouses. Then post-COVID, we actually kind of pulled things back in to adjust for the new demand. We're able to do all of that because of the control that we have over the supply chain.
One of the things that you and I have talked about as well in the past is the makeup of your team. And, as we're focusing this week on some of the employment situation data that we're going to be getting in pieces as the week goes on, just talk to us about how your team is made up and how the Misfits name of the company also translates into making sure that you're bringing people together from all walks of life to really deliver this mission.
Absolutely. So, we have a team of 1,000 plus folks all across the country, and we're an operations business at the core. So we have a corporate workforce just like a lot of other startups do with marketers, engineers, product managers. We also have a really big workforce of folks that are on the front lines who are packing boxes in the fulfillment centers, who are delivering boxes in our trucks, our drivers, and that's a huge part of our population as well. And all of those folks come to us because they have this shared enjoyment of the mission to rescue food and to deliver value to our customers. We started in North Philly 5.5 years ago, and we had a second chance program that we still operate today, whereby we're essentially hiring folks who were incarcerated before, who got out. They're trying to figure out a new path in life, and a lot of other companies don't hire folks like that. They'll have very strict background checks that filter those folks out. We don't do that. It still comprises a big part of our workforce, the fulfillment centers, and we're going to continue to do that.
That's amazing effort that you've been putting forward as well, and making sure that in that second chance, you're giving people the opportunity to re-enter into the labor workforce. As you think about the broader shifts that need to be made, especially in your industry, in how you're maintaining talent, walk us through the mindset that you have to employ, especially for a corporate culture, to be able to attract and retain talent, even right now.
Well, I think that the summary is, I think it's gotten a lot harder over the past few years. I think, it's not just about the dollars that you can give someone. It's not just about the benefits on paper on the offer letter. I think what we're seeing more and more is, workers have a ton of different options out there, and they're going to go somewhere where they feel like there's a mission that matters, that aligns with their worldview. And so though we've been, we're super competitive on compensation, we have a ton of amazing benefits, everyone who's part of Misfits Market, they get a free box of fresh produce and other items every week. We're also really focused on making sure that mission alignment is there, and that we're showing that off, because that is such an important part of how people choose their jobs these days.
All right, we know you have a new partnership with GoPuff as well, a collaboration of forces between two Philadelphia companies. Love to see it. Abhi, thanks so much for taking the time here this morning.
Thank you.
Absolutely. Misfits Market CEO Abhi Ramesh joining us here in studio. Switching gears, we've all heard the phrase, health is wealth. Well, for millions of Americans, diabetes and weight loss drugs known as GLP-1 agonists could be the key to helping unlock their healthiest selves. But many who take the drugs stop after a year or less because of the side effects. Well, health store giant GNC is looking to help ease those side effects and help people stay on medications. Joining me now, we've got Michael Costello, CEO of GNC. Michael, thanks so much for taking the time here in studio.
So glad to be here, Brad.
I mean, this has been a huge issue over the last year. The amount and the amount of people that have flocked to GLP-1s and weight loss drugs that actually have other proven use cases, but then there was also this that it sounded like, and was proven medically as well, that it can help them lose weight and tackle obesity as well. But there's another side of that. What are you tracking from the GNC side?
So, Brad, if you think about it, GNC has been helping people live well since 1935. That's always been our mission, and we've been a mission-driven company since the beginning. We're looking to help consumers in whichever health journey they're on. With GLP-1s, many folks, over 40% of Americans are trying to lose weight. And over 12% of US households right now have somebody taking a GLP-1. But as you said, 50% of people go off it early because of these side effects, normally GI issues, but also other issues with muscles wasting, as well as with not getting right nutrition or energy. GNC has had all these products, and we have a group of scientists who are able to go out and work with consumers, work with the different products, and give consumers a very easy way to come in store, look at what the products are there, look what side effects they're getting, and being the first company out there to help consumers with this journey.
Certainly. And so as you think about how you're going to kind of deploy the side effects business, the GLP-1 side effects business within GNC, what does that look like?
So if you come in store, you will see we've actually merchandised a whole wall with all of the side effects, the descriptions of the side effects, and various products that can set up against there. So for instance, if you have digestive health, we have shakes like Super Gut that can help you in your digestive health. We have probiotics and ginger. If you're worried about the fact that you're losing too much muscle mass, which is one of the side effects of GLP-1s, we have HMB, which has over 40 peer-reviewed studies how it helps maintain your muscle mass. Yeah. We use creatine as well as other products for proteins, whatnot, which you might need. We also have energy products in case you need energy, and also because you're consuming a lot less calories, you may not be getting all your nutrition. So we have multivitamins geared towards that.
We're talking about drugs or supplements to offset the effects of other drugs.
So we don't sell drugs.
Okay.
We sell supplements. We sell products that are out there that have been built for really helping your body, naturally helping your body in different ways.
Okay, so like basically a biophysical compound that is proven more safe, efficacious.
So very safe, right? Very efficacious. Now supplements are not drugs, so drugs have a different set of efficacious.
Sure.
But the supplements there, many people, as I said, if you have digestive health issues, people have come to GNC for a long time for these things. If you're not getting the right nutrients, people have come to GNC. Now we're just giving you an easy way to come in store, see all the side effects, and our coaches have been trained. Right. We've done extensive training. We actually shut down all of our stores I was there in store from 8:30 till 11 o'clock in Queens.
Okay.
With all the coaches going through training so they understand when consumers come in with whatever side effects they have, what all the right products are for them to take.
Pricing, what does that look like right now?
Our pricing is pretty flat. I mean, we'll have some puts and takes in pricing, but we don't see an overall inflation in our categories.
Because that's the concern, is that within the broader healthcare space, because the mindset of the consumer would naturally annex this, regardless of whether it's a supplement or whether it's something that a doctor tells them to go get. They just say, okay, that's healthcare. That's an added cost now that I have to think about if I'm getting a supplement on top of it.
So as you know, many of the folks who are on a weight loss journey or diabetes actually are spending lots of money on these GLP-1s. If you think about it, our added cost is a way to help them maintain that to actually reach their goal. Who would want to spend all this money and actually not get to the end point?
Absolutely.
We can help them get to that end point.
The outlook for GNC this year, what are you anticipating?
You know, we've seen all the trends that we just talked about with misfits and consumers. Consumers are definitely pulling back a little bit. But, you know, our weight management category is up over 20% right now. And that's before we launched this wall. Because we've also launched Glucotrim, which is a natural alternative for folks who don't want to go on drugs. And we're seeing great uptake on that. Because as folks really try and think about their health, as you said, health is wealth.
Yeah.
You want to avoid those doctor visits. You want to avoid the additional medical costs. The best way to do that is take care of your own health. And GNC can help you do that.
You know, just lastly, while we have you here, and we only got about 30 seconds, I mean, the rise of the fitfluencers out there, whether it be on Instagram or TikTok or any social media platform, what is the delta that you've witnessed in your business as a result of that? As people see other lifestyles or see other, perhaps, I dare say, I don't want to say a pedestal, but something, because it makes us compare ourselves.
It does, it does.
So there's the comparison that is unhealthy, but there's also perhaps the goal setting that might come along with it.
There's goal setting and also knowledge.
Sure.
Right? So there's products that folks maybe not have known about that a lot of those influencers can actually help make more important out there. And we see it in our stores. We see when something blows up on TikTok, when something blows up on Instagram, and those influencers are all kind of congregating that, there will be folks coming in the store to really ask if it's true. Because you're not sure when you watch on social media what's really right or not. Our coaches have been trained to help them understand what's really real and what the benefits are. So you can come in our stores, find those products you saw on TikTok, and we can help you know what will help you or not.
Michael Costello, GNC CEO, thanks so much for taking the time here this morning. Making the trek from Queens this morning.
Yes.
Appreciate it.
Thank you, Brad.
Thank you. You guys, coming up, the Biden administration announces more potential student loan forgiveness, but what if you don't qualify? Well, we've got some tips to pay off your student debt next. another big deadline for federal student loan borrowers. Some may qualify for a one-time debt cancellation or credit, but they'll have to take action by Tuesday. The Department of Education is making a one-time adjustment that could allow millions of federal direct loan borrowers to receive at least 3 years of credit towards loan forgiveness, and many will see their loans forgiven automatically. If you hold federal student loans like the Family Education Loan, Parent Plus loans, Perkins Loan, or a Health Education Assistance Loan, you have until tomorrow, April 30th, to consolidate them into a direct loan and take advantage of this credit. This comes as the Biden administration has doled out $153 billion in student debt relief to 4.3 million people through various actions so far, but many Americans won't get this adjustment. So how and what is the best approach for them to pay off their student loans? Joining us now on this, we've got Yahoo Finance contributor Ross Mack. Ross, give us your tips for paying off student loan debt.
Brad, thanks so much for having me. I would say when it comes to student loans, you gotta approach it like any other form of debt, right? Everything starts with having a well-constructed plan. And the first plan of action when it comes to getting out of any form of debt is you have to make sure you're budgeting, right? You got to be able to control your inflows and outflows so that you can understand where you can actually cut expenses and other frivolous matters to actually now apply and actually have a little more money to start paying more than just the minimum, right? I think quite so often everybody's just paying the minimum, and you look up, you're paying things off for 7, 10, 30 years or probably the rest of your life, right? And so got to start with that budget, right? Now you're trying to figure out, okay, could I put an extra $200, $300? The moral of the story is you don't just want to get stuck on paying the minimums, right? And I think that's the biggest thing. So start with your budget and start actually saying, okay, I want to now start paying more on this debt to actually get out of it a lot quicker.
So how can all the kids out there, the future college students, avoid student loans altogether?
I love that question, right? Obviously, as a parent, that's my number one goal, is to ensure my children don't have student loans. Because guess what? When I graduated, I had student loans, right? And I had to pay them back. And the idea is, one, right? Obviously, your parents could try to get you maybe a 529 or, a custodial account, or your parents themselves are saving money. But say you didn't have that, right? Now you ask yourself, okay, what do I need to be doing as a high school student entering college? Well, one, you got to fill out that FAFSA. You got to see if there's any type of, grants or anything like that. Is there any federal aid that you can get? Then next, I would look up scholarships. And then lastly, I would probably say, right, so one, I think I kind of just moseyed over the scholarship idea, but you definitely want to look up scholarships and grants. There's billions of dollars available and millions of dollars available every year. So do not, right, everybody's spending so much time on social media, right? Actually spend some time on Googling how to find a scholarship, right? And I think lastly, another thing to consider is, hey, maybe you might want to do work study, right? I think there are a lot of cool jobs on campus that can pay you to pretty much just learn, right? You sit there in the library doing your homework, and hey, you could also get a paycheck while you're doing it.
Yeah, we actually had the founder of Scholly on Yahoo Finance as well just a few weeks back, and that is one scholarship search tool as well out there that could help a lot of folks. All right, thanks so much, Ross. Appreciate it.
My man.
Switching gears here, but kind of in the same thread. A top trending ticker on Yahoo Finance right now. Shares of SoFi. They're falling as a disappointing second quarter outlook outweighs strong Q1 results. Adjusted revenue and EBITDA for Q2 missing analyst expectations. In the first quarter, the company did see some of the strong growth in loan originations across the board. You're looking at double-digit year-over-year growth for personal and student loans. Home loans up a whopping 274% from the prior year. Here to dig into the results, we've got SoFi CEO Anthony Noto. Anthony, great to grab some time with you on the back of the results that you announced for SoFi. Just broad strokes to start things off, I wonder what you're seeing in the demand environment for loans right now.
I'd say the demand environment for loans has remained strong as rates have gone higher. Consumers have looked for lower cost debt, and so we've seen really strong demand for unsecured personal loans to term out revolving debt with variable rate to fixed rate and fixed term. On the home loan side of the equation, it's largely been purchase demand, not refinancing demand, given how high rates are. And then on student loan refinancing, I'd say the demand is well below where it would be if rates were 200 to 300 basis points lower. So I say it's a tale of two cities. People with high revolving debt need to refinance to term and fixed rate loans, but the refinancing side of the equation is not very strong, not very strong at all.
When we look at the new member additions, 622,000 roughly in the quarter, and total members reaching over 8.1 million by the end of the quarter, which is up about 2.5 million from the prior year period. All these things considered, we've heard different classifications of the consumer being resilient or the consumer being healthy, but we're starting to hear more about the consumer being stretched. Where do you fall within that camp?
Yeah, we're going after a segment of the market that's higher in credit and higher in income. So it may not be representative of the demographics that are being talked about. We're seeing really strong demand. Our business grew 26% year over year for total revenue, but the tech platform business and the financial services businesses grew combined 54% year over year. We had record deposit growth at $3 billion. We had really strong AUM growth for SoFi Invest business. We're seeing good trends in our credit card portfolio performing better. So overall, we're seeing more spending, more deposits, and more engagement on those products that I mentioned. We're also seeing continued spending through our payment processing platform at Galileo and strong trends there from consumers. In terms of life of loan losses, our outlook remains that we'll have life of loan losses of about 7 to 8%. We are seeing credit performance normalize. It was quite low on the back of COVID and all the aid that was provided, but we've articulated that those losses will go up and normalize back to where they were pre-COVID levels, and that's exactly what we're seeing.
We're approaching some key education deadlines, especially for higher education and college goers who are anticipating beginning coursework perhaps in the fall here. And notably, there have been some issues with the federal and FAFSA side of the equation. How has that kind of dovetailed over to your business and ultimately where some of the student loan, personal loan originations have started to come in?
On the in-school loans, we'll see more of the in-school loans being pushed towards Q3 than Q2, given some of the issues with FAFSA. In terms of eligibility for student loans that already exist, individual consumers should go to the Department of Education websites to make sure they're informed on the different options. It's quite complicated. There's a lot of information to read through. We can also provide you with education as it relates to the different choices that you have. But we're at a point in time where there's a lot changing in terms of federal student loans. If you have private student loans, those can be refinanced through SoFi quite easily. But again, you really have to understand the pros and cons and consider all the implications for your individual situation.
Anthony, we were just having a discussion with one of our contributors, Ross Mack, about how people can make sure that they don't have loans by the time that they graduate, or they're paying them down very quickly on the other side. For a lot of those out there whose college decision might be drastically different because of the rising costs and the cost of college versus how much they're anticipating to make thereafter, I wonder where we're starting to, or where we expect to see some of those costs ultimately come down. Are we seeing that at all? And what is the pass-through effect for your business?
I don't think college tuition is coming down at all. It's continuing to go up, and it, quite frankly, is becoming very challenging for an individual to fund their college education if they don't have the benefit of family that can help them with paying tuition. Obviously, there's financial aid and other avenues to go down. The thing I'd emphasize more than anything else is that when you're choosing how to pay for college, that you think about the job that you're going to have when you're done with college based on your major and what the income of that job is once you graduate from school, and make sure that you're going to be able to pay those loans back at a rate that doesn't cause you to have no discretionary income or to have to take on additional debt to live day to day. Ideally, the cost of your loans relative to your income will be substantially below your disposable income, so you have excess to be able to invest in your 20s. Getting that formula right is really critical. Many college-going new entrants are misled that they can afford the amount of debt for a specific major. It's just not true. They have to do the math on their own on what they would make on a post-tax basis, what they would need to pay for, the housing as well as food and entertainment and transportation, and then what's left from there. Can they invest, or is it all go to pay off their student loans? And getting that equation right is really critical to not digging a hole when you get your first job.
Anthony, just lastly, while we have you, we got to talk about the home loans. That was flat year over year. Of course, within the housing market, we're still waiting for and it seems like a lot of buyers and prospective sellers are waiting for it to be a more favorable environment for both of them. When that comes, unknown, because it's largely hinged to the Fed here. I wonder how much you're continuing to track the Fed's every move, given that it will directly impact that home loans part of your business.
Yeah, we're following the Fed very closely, like everyone else. If we did see declining rates, our home loan business would do much better. There'd be more demand for the home loans. We largely do government agency loans, which means we could underwrite as much demand as there is, since we know what the formula is required for us to pledge those loans to the government agencies. And that business would have a great tailwind with declining rates. Student loan financing will also pick up meaningfully in declining rates. But right now, the market's only pricing in 1 to 2 rate cuts. And if that even happens, we'll have to wait and see. But if it does happen, the outlook will be better for us than it is today. And we could be more aggressive in home loans and in student loan refinancing. So it really depends on where the Fed goes, and that's premised on where inflation is and where the economy is.
All right, that could be our own thought process every single morning. What will the Fed do today? Many of us wake up with that very thought. We know you do probably as well. SoFi CEO Anthony Noto, thanks so much for taking the time here.
Thank you for having me.
Absolutely, great to see you. We've got much more on wealth after the break, everyone. You're watching Yahoo Finance. Shares of Phillips skyrocketing this morning as the medical device giant agrees to a $1.1 billion settlement for personal injury cases linked to potentially faulty respiratory devices. The payment, much smaller than anticipated, and analysts had predicted a settlement between $2 and $10 billion. They also reported earnings. Here with more, we've got the CEO of Phillips, Roy Jacobs, who is alongside Yahoo Finance's healthcare reporter, Anjali Khemlani. Anjali, take it away.
Thanks, Brad. And hi, Roy. Really good to have you on the show again. Earnings, let's start off there because that came in with a miss despite this good news of the $1.1 billion settlement. Talk to us about all of that and what this relief from the litigation means for the company.
Yeah, so we had 2 important parts of news. So actually, if you look at sales, actually we delivered in line with plan. So 2.4% CSG growth, which was also in line with consensus on the back of a very strong last year growth of 6%. Then we had a beat in margin improvement, where we delivered 9.4% and 80 bips margin improvement in the quarter, which was very strong and better than expected. And then we also saw order intake turning positive outside of China, especially on the back of a strong North America market momentum. At the same time, we could announce a lot of progress in resolving the Respironics recall. We got court approval for the consent decree. We got court approval for the economic loss settlement. We got an insurance settlement for 540 million contribution for all product liability claims. And then most importantly, we got to a settlement for the personal injury and medical monitoring cases in the US. Now, and that was very important because that takes away a lot of uncertainty that was hanging around what this could mean for Phillips and the way forward. So now with this clarity on the way forward, we also have reaffirmed our plan for the year and our commitment to deliver 3 to 5% CSG growth, a further step of adjusted EBITDA to 11 to 11.5%. And then also we increased our cash guidance for the year from 8 to 900 to 1.1 billion. And that then includes payment of the economic loss settlement and the income of the insurance income. So therefore, we could reconfirm the plan as well as show inline start of the plan in the quarter and very strong progress on resolving the Respironics case.
Absolutely. And all this, of course, we've seen the action in the stock today. Really positive news there. Meanwhile, you're not out of the woods just yet. I know you also have the DOJ investigating. You got a new warning letter from the FDA over manufacturing in China. And you also have the other event, the home ventilator market that you pulled out of. So talk to me about all of this. You still have a lot more, coming down the pike that you have to deal with. How are you dealing with accountability inside the company with all of these problems?
So by actually closing the settlement, we have taken the vast majority of the cases out of the way, and especially the three litigation cases that were there in the US: economic loss, personal injury, and medical monitoring. So actually that is a closed chapter now, and that was very important because actually the biggest uncertainty was tied to that. It is true that still the DOJ is remaining. We're fully collaborating with that. We have given the information that they requested. There's no further clarity on what that would mean and when they would come forward. We also have put patient safety and quality as the #1 priority of the plan that I presented last year. That also means that actually we are working through all of the businesses to ensure that we have the highest quality norms that we work towards. That also means that we need to address findings such as indeed were found by the FDA, and we are in strong collaboration with the FDA. Those were process findings, no patient harm, and we're working through those at the same time. But most importantly, if you see that how the rest of the company has started to perform in the first year with a strong actually over delivery versus the first year targets that we set on growth, on margin improvement, and on cash flow generation. Now also we see that the second year we started in plan, and with the clarity on what this would cost, we also have now the cash flow and the own cash flow that we can finance this out of. So it's not only about the cost, but also that we take control of our own destiny and can continue to fund in the exciting innovations that the healthcare market is requesting from us. Also the consumer market that starts to further pick up, especially also we expect in North America that we started with a 3% growth, but that should strengthen in the rest of the year. We see sellout momentum growing. And we also see actually that in the healthcare market, the North American market is strengthening. We closed a very exciting deal with the Nicholas Children's Hospital, where we're providing very specific solutions, both in the radiology department as well as the monitoring department, to give a better experience for these children and the patients, and actually to also increase the productivity and therefore the capacity of the hospital to work through the patients. Because with the shortages of staff they're experiencing and the cost pressure, actually also they need innovations and AI and software to actually help them in delivering a better performance towards their patients. Absolutely. So that's something that we have been able to report into this quarter. And the focus on innovation is actually what this allows us to really further dial up on.
Certainly. Well, definitely an exciting day as the company gets to regain some of that market share that it had lost in the last several years. We'll keep an eye on it for the rest of the year. Phillips CEO Roy Jakobs, thank you so much for joining us.
Thank you so much.
Brad?
All right, thanks so much, Anj, for that conversation. Everyone, that does it for now. You've been watching Wealth. I'm Brad Smith. We'll see you tomorrow at 11 a.m.